Sorry, I have to ask, Chris, do you work with Susan?
Good afternoon, good afternoon, good afternoon. Welcome, welcome, welcome. John Sorensen here, President of the New England Canada Business Council, and I want to thank you for joining NECBC. Together, here are 2021 U.S.-Canada Business, Economic, and Trade Executive Forum. We are so excited. We've got a dynamic program today, and it'll be going from now till about 5:40. And then we're doing a network session right after that. And that's network session will go from 5:45 to 6:30. And it will be a separate Zoom link, and we will send that along to you. We pulled together a preeminent Canada and America financial services and fintech industry leaders, entrepreneurs, investors, and international trade and political experts. They will provide their perspectives. They're going to share knowledge and explore a wide range of topics revolving all around fintech and the future of the financial services sector, and as it relates both here in the United States and New England, and of course, Canada. Executive discussions will also include the perspectives of the future evolution of our strategic economic investment and trade relationship between the US and Canada. And of course, as you all know, or if you don't, you should, the largest bilateral trade and investment relationship in the world is between the United States and Canada. So we're very, very pleased with what we have today. We can't do this without sponsors. And as you can see, we already have a beautiful logo up there, but TD Bank, a big thank you to TD Bank, our Platinum Conference partner. And then we have gold sponsors, Rasky Partners, Comcast, which has been helping with the media, Deckert, TMX, A2C. Thank you again for your gold sponsorships. Our premier sponsorship, John Hancock, and thank you for John Hancock. And our associate partners, Connect, which is a coalition of New England companies of trade, and the New Hampshire Business Association, NHBIA, Jim Roach. And thank you again, all to our sponsors. Again, we have a dynamic event today, and I'm sure you've all seen it. The who's who in the business world as it relates to our topics. And to kick us all off and introduce our superstar opener is my friend and regional president, Steve Webb of TD. Steve?
Good afternoon, John, and thank you for those kind words. As John just mentioned, my name is Steve Webb, and I'm the regional president for Southern New England at TD Bank, America's most convenient bank. And I oversee TD's commercial and retail banking teams in Massachusetts, Rhode Island, Connecticut, and upstate New York. It's a pleasure for us to be here today for an event that will be jam-packed with informative content, including panels later in the day on the future of financial services, fintech, policy, and the regulatory dynamics in the US-Canada trade relationship, and even more. We're a proud sponsor of today's event, and we support the New England Canada Business Council's mission to sustain and expand the strong and mutually valuable connections between New England and Canada. As many of you may know by virtue of our name, it should be obvious, TD Bank is a member of the TD Bank Group and a subsidiary of Toronto-Dominion Bank of Toronto, Canada, which is a top 10 financial services company in North America. So this relationship with TD, or with Canada, is extremely important to us, as I'm sure it is to all of you. Now further, specifically in New England, trade with Canada is vital to our local economies, and Canada is a top trading partner for all 6 New England states. Now with this in mind, and to lay the groundwork for today's event and discussions, I'm pleased to introduce our keynote speaker, Beata Caranci, Senior Vice President and TD Bank Chief Economist, who will discuss the outlook for the global North American and New England Eastern Canadian regional economies in trade. Now, please feel free to type your questions for Beata in the Q&A chat feature on Zoom, and she will attempt to address these questions later in her presentation. Now, a little bit about Beata. She joined the bank in 2003 and leads an agile team of economists who are tasked with delivering economic content on Canadian and US stress test regulatory requirements, as well as the baseline forecasts and research publications for TD clients. Now, her team delivers on a wide scope of research covering the Canadian, US, and global economies. So there's a lot to do there. Beata is also chair for our Expected Credit Loss Scenario Governance Committee. She sits on our Retirement Investment Committee and is a member of the C.D. Howe Institute's Monetary Policy Council. She's also a member of the Economic Council at the American Bankers Association, which meets with the chair of the Federal Reserve twice annually to discuss economic and policy views. And by the way, she's accepted the chair position of that committee for 2021. So congrats, Beata. And Beata is also a passionate supporter of our diversity initiatives and has actually dedicated more than a decade to researching and driving awareness among Canadian policymakers on the labor market friction experienced by women. And certainly during the pandemic, we've seen more of that. So thank you, Beata, for that. And her research report called Get On Board Corporate Canada actually helped influence the Ontario Securities Commission's rule amendments on disclosure of women on boards and in senior management. Beata holds a master's degree in business economics from Wilfrid Laurier University in Waterloo, Ontario, as well as a BA in economics from the University of Toronto. And prior to joining TD, she had the pleasure of working nearly 4 years on a trading floor, providing economic analysis to foreign exchange, money market, and bond desks. So please join me today in welcoming Beata. Beata, over to you.
Thank you. Thank you so much. And by the way, when you're told to be chair of the American Bankers Association, that's code for just a lot more work. But it's an honor. And it is always an honor to meet with Jay Powell and company, as you can imagine. So I'm hoping you can see my presentation because I don't have that viewpoint, but hopefully you do. Oh, there you go. No, I do. Okay, so a loaded title, The Pandemic's Push for Economic Change. However, we're going to cover 3 topics, and anything that's missing, feel free to ask. So if we move to the next slide. Here are the 3 areas I wanted to touch upon. And the first is the international lessons of what we can learn from vaccination progress. Now, obviously, the US is a very mature vaccination process and is a world leader. However, what we expect from the US in terms of reopening is not necessarily what we're going to see in the rest of the world. And so what we are using is the experience of the UK and Israel in particular to be our guidelines, because their model is more likely to be followed by European countries, Canada, and even Asian countries in terms of having more of a federated model on reopening as opposed to state-led initiatives that can be much more difficult for to follow because they'll be so different. The next area will be the U.S. economic outlook, of course, and then we'll move into the monetary implications. And, you know, the Fed is meeting actually today at 2 o'clock, so hopefully I front run some of their commentary that they're going to be having at 2 o'clock. So if we move to the next slide, you know, here is the vaccination rates on your left between various countries, and you can see how much Israel was and remains a front runner on this, and the UK being second, but the US quickly catching up on all fronts. And like I said, Israel is offering a global model of what we might expect, and from there we can judge what the willingness and speed of reopening is going to be amongst international economies. And the reason that's important, of course, is that you can have your state borders open and international borders open, but that doesn't necessarily mean everybody else will. And so what's likely going to happen in terms of dynamics is that the global economy is recovering slowly. Israel and the UK are an outlier. The US is the net importer of the world. So the stronger and stronger you become, the more likely it is you pull in products from other places of the world, helping their recoveries, by the way, but not necessarily have a strong export market yourself. So it does matter in terms of what we're seeing internationally and what we can glean from those experiences. The graph on the right, which is showing you Israel's vaccination rates and cases of COVID, I find really interesting because I know the dialogue in the US right now is, hey, we're starting to see a slower vaccination rate in terms of first doses This is not unusual. Don't hit the panic button. Don't worry. Israel saw the same, and so did the UK. As you move through the different age cohorts and you hit those young cohorts, which is now happening, the vaccination rates do slow down, and so the take-up takes a little longer. So even in Israel, which is already, almost at herd immunity, they had their peak vaccination cycle actually occur in January, and in March it was already moving through the younger cohorts and slowing down. Irrespective, you do see the cases dwindle quite a bit. So as they hit those youth pockets, you start to see the cases almost go to negligible amounts, which does tell us an important lesson here, is that we do need to hit herd immunity for those case loads to get to that very low and relatively insignificant portion, because there's always portions that are still unvaccinated, especially those who don't qualify for the vaccine, which are children. The other lesson that we're learning is that even though Israel is very high on their vaccination rates, they are still not open in terms of normalizing economic activity. And so there's a very gradual approach. It will likely be the model that's followed by other countries, mostly because the variants have put in a much higher bar to reopen the economies as everybody experiments with that factor of transmission and how fast it can occur. And then the other factor that we're starting to see globally is the degree of vaccine passports. And so while the US does not want to instate it domestically, what we're seeing other countries, the UK, Europe is talking about it, Israel, various forms of passports to enter countries and move around the countries. Enter restaurants and Israel, there's like a green passport to enter into an indoor restaurant. The UK is playing around with like a red zone and green zone in terms of your ability to move around. So there's a lot of lessons there that the criteria for movement of people is going to be different, at least for some time in the post-vaccine world, as we go through some of this experimentation of how to get through to herd immunity and what that actually means for transmission. So in the post-vaccine world, we're still in a very uncertain period. It's just getting defined differently. The vaccines have solved for the health crisis, but not necessarily yet for the flow of people and tourism flows, and that's really important. If you think of the border between Canada and the US still closed, I liken it to, the days when I got stuck in airports and we kept getting through flight delays, and every 20 minutes you'd be told it's another 20-minute delay, and this would go on for hours. So just like our borders, every month we're told another month delay. The dialogue is not quite there in terms of when we're going to reopen, and that's because Canada is behind on its vaccination rates relative to the US. But the US has a tourism surplus with Canada, meaning Canadians spend more in the US than vice versa. And so the longer those borders stay closed, that does choke off about $12 billion in funding that would be going back across that border. And the other factor that's important is that while you can get your restaurant industries and hospitality industries up and running off of domestic dynamics, tourism is a huge deal in terms of having a strong economic multiplier. Like every dollar spent gives you $1.70 back, right? So a very large positive multiplier. So you do need that international flow to really have normalization of some of these industries where they're just not depending on the domestic population to sustain. To really get a positive dynamic, it requires open borders. And so that's definitely not where we are. And very few countries are at herd immunity. You will be the exception in short order, the UK, Israel, but many others will be months, if not a year, behind you in terms of what we're seeing in the emerging markets. So if we go to the next slide, this is showing you the extent to which Israel has reopened. Considering how high their vaccination rates, they're very cautious on aspects that have to do with indoor. And so, if you think through when will Canadians be coming into the US and when will you be reopening? Well, Canada has set a threshold, or they're talking about a threshold of not just meeting 70-75% on first vaccinations, but another 20% on second vaccinations. And so that takes you out to September. So it's not clear if the borders will open before then, but that gives you probably your end point of when that might be. And interestingly, you can see from this that Israel has not opened their borders yet and don't intend to until May, even though they are at very high levels. So a lot of information to glean from there. And we're seeing some of these patterns replicated in the US and some not in terms of what states are willing to reopen. So the next slide is going to show you that basically, although we're moving toward these gradual reopenings, everybody's moving in the right direction. This is very US specific slide. And what this is capturing is time spent out of the home, people moving around as restrictions are relaxed. So everybody's moving in the same direction. New England the region does have a more cautious approach in general. Some do, like Maine, New Hampshire don't. But overall, nobody is fully normalized, right? Even in broader US. So it is a gradual process and a cautious process for good reason. And there are some key themes that we're seeing coming across by the various states. Everybody approaches this differently, but key themes are outdoor activities, just like Israel and the UK, are prioritized because of the lower transmission rates that occur. So those are the first to come open, and that we're seeing pretty much as a global theme. Domestically in the US, we are seeing a relaxation of indoor capacity, but still capacity restraints there. So example, Maine is relaxing its indoor capacity, but it's still at about 50%. So it takes time to get to that 100% because you're testing all along the way for where you might get flare-ups. We're hearing now more and more, as I mentioned with the passport themes coming out, that vaccinated people seem to be getting more freedoms in terms of what they can and can't do. And the CDC guidance yesterday was a bit of a reinforcement on that in terms of mask wearing. And then again, many states are aiming to, perhaps symbolically, to have July 4th as a period where it's back to party days and being much more open than we've been accustomed to for the last year. Now it's symbolic. We'll have to see if the data will match up to the ability to do so. But that does look like that would maybe a good pivot point for the US, which means that if that happens in July, August, and September really become your true test. Because this is going to test the effectiveness of the vaccines against any variants that may be out there and more resistant, like the South African strain. And remember, children are still unvaccinated, and so the degree that transmission occurs through that second level will also be tested at that point. So just a reinforcement, vaccines are fantastic. We love them. We're starting to see everything reopen. But it just introduces a new experimental phase as we try to figure out the path forward. So it's an interesting social and economic experiment that's still ahead of us. So if we go to the next slide, this is basically showing you the outcomes of the restrictions, and they are completely intuitive, and there's good news to be offered in looking at this slide. So the one on the left is showing you your retail and recreation mobility. Those states that have relaxed more are seeing more movement and visiting of these locations. Likewise, the one on the right is showing you employment outcomes. And so it's not a coincidence that these identically mirror each other. The states that have the loosest restrictions also have the better employment outcomes. So don't be discouraged if you're on the Vermont and Massachusetts side, because what this does tell you, as you continue to gradually relax, you will end up looking like, in terms of job markets, what those Maine and New Hampshire experiences are looking like. So they continually get better over time. So the impulse there is a natural improvement as we go forward. As for the broader US, the next slide is basically showing the resilience. And this is why I'm not overly concerned that as restrictions are relaxed, things have a natural buoyancy that will be coming through. And so what you're looking at here is the ISM indices. And if you're not familiar with those, they are forward-looking indices, both on manufacturing and services, which asks employers, what's your intention to hire? What's your intention to invest? How do your inventories look like? How do your exports look like? And so anything above 50 is saying growth. We're in growth mode, and we anticipate further growth in the months ahead. And so what we're capturing here is a dichotomy that you see between Europe and the US. And this has been a very strong theme. You can see in the graph that the US has been in positive territory for some time. Europe is struggling on the service side. Again, this is related to the restrictions. Europe has had restrictions in place pretty broadly since about the fourth quarter and have been having trouble relaxing them because of the virus. Some, like Italy, are now starting to do it, but they're doing it at levels where they haven't really controlled the virus spread. It's come down, but it's not at levels probably that are low enough to give you assurances that they may not have to reverse course as we go forward. So that speed of vaccine, that vaccination process is so critical to the outcomes we're seeing in terms of the normalization of the economy, which makes sense. But it also tells you that the US is going to have a very large growth advantage to many of its peers for probably some time. And that's why I say that you're likely going to see the trade flows continue to be where you are importing because your consumer cycle is going to be really blowing out the lights compared to other regions. And you are high importers, especially consumer goods. So any tensions that exist now on the trade deficit or with China are certainly not going to be getting better. The dynamics are in place for that pressure to persist on the US. So a growth outperformer, but it will come with a side of pain on the trade side. And so if we move now into that second agenda item, which was the forecast, this is giving you an idea of the forecast changes related to stimulus. Now, again, nothing in this graph is capturing the recent announcements in terms of America's job plan or what will be announced later tonight. So this is just capturing that first 1.9 trillion tranche that took growth in our estimations up to around 6%. However, the Federal Reserve's at 6.5% on this for the year. These are really big numbers. And I would say they're restrained numbers. If we let our models do what our models want to do in terms of interpreting the impulse from the fiscal stimulus and spending, we would have had growth somewhere in the range of 7 to 8% for this year. So there's a strong impulse. And the reason we didn't is we did put some restraints on the model because we want to understand exactly what consumers are going to be doing with all this excess savings that's showing up on balance sheets, estimated to be about 2 trillion in savings, higher than what you would have seen pre-crisis. So some of it will get spent, some of it will not. It will go to debt pay down, some of it will be saved. And so the reason we restrain the model is to take that into consideration, but it gives you an idea that there may be a stronger springboard effect here than is built in the model. So we'll take that into the next slide, which is basically saying part of that fiscal stimulus package, which was really important, I know it was controversial, was the money to state and local governments. And this gives you an idea of how the Northeast compares in receiving the funds as a share of the US. It's about $350 billion that was distributed in assistance, and it was split, about $200 billion, just under, to states. And that determination of funds was based on levels of unemployment that were existing around the fourth quarter of last year. And then the money that went to the local side was more population-based in terms of how it was distributed. The reason I'm raising it is because when you think of a recovery and a wholesome recovery, it has to involve the state and local side of the government. It does account for about 15% of job losses, just over 1 million. So if you don't engage a state and local side recovery, then you actually don't get a wholesome U.S. economic recovery. And backfilling some of these coffers actually accelerates the recovery, not just in the private sector through all the contracts that are engaged, but also in the public sector. And so it's a bit more of a wholesome recovery. And this was a lesson that was learned in the global financial crisis, that really the state and local government hiring held back the recovery because it took much longer, more than a year longer than the private sector to recover. And we saw that in the recession prior to that. So the hope is that part of that rebound in the economy is that we're going to see broader job recoveries than we've perhaps seen in previous cycles. So if we move to the next slide, this is an interesting one. So if you look at the column under 2021 and 2022, now these growth rates are different from the ones you just saw previously because they're annual averages as opposed to fourth over fourth, different metric, still showing the robustness of the growth. And you can see that when you look at 2021, the growth rates aren't that different. They all look pretty good, right? 4%, 5%, 6%. However, when you look at that column that says reach pre-pandemic level, this is where your GDP is back to pre-pandemic level. You can see that the US is pretty much there in the second quarter. Canada will be followed, and then you move into the European countries that come in after that, and then the UK would be last, dealing also with the Brexit issues that really pushed them into a hole, as well as Japan being last. So that's the first threshold to cross in terms of the recovery. The more meaningful threshold is the one that I've circled in red here. This is where you've absorbed all the excess capacity that got built up. So you're not just trying to get to where you were 2 years ago, you want to get to where you should have been. And so that occurs pretty quickly inside the US, but look how lagged it is everywhere else. And this is reinforcing the theme that I mentioned about the speed of recovery and where you're going to be positioned relative to your peers. And many not looking at that point of time until 2023. This is important because when you're the Federal Reserve or the Bank of Canada or the UCB, this is the one that matters in terms of where you start to move into areas of balanced growth and more inflationary pressures that could be sustained as you get further out in the timeline. And what this is suggesting is that the US will be amongst the first to increase interest rates, and probably the Bank of Canada along with them. And we will have very different experiences in Europe, where they could be multiple years behind. And if anything, much more risk of them pursuing a deflationary cycle, whereas the talk all in North America is about an inflationary cycle. So very different outcomes that roll out of this simple table. So if we move forward and look at like how is this recovery taking hold within the consumer or the business cycle and the consumer cycle, you know, here's you've got some pretty nice V's looking across. A lot of people have referred, including us, as that Nike swoosh, you know, in terms of the recovery, coming down a little longer to come up on the recovery. So you could see a little bit of that coming through on these profiles as well. I think what you want to really take note of is how different this cycle is relative to the last, and in particular, I know we talk a lot about the consumer cycle, but the business cycle has been where the biggest surprise has been, that it has recovered at a much faster rate than we've typically seen in previous cycles, and by years, as much as 4 years faster in terms of getting to pre-crisis levels. And so that is an aspect that is encouraging and so different on this cycle than we've seen in the past. Now, part of the reason it's recovered is related to this next slide. This slide that's coming up will show you how much of business support on C&I lending, which is commercial and industrial lending, so it's banks lending out, how high that is relative to what the level of investment is. So this is the PPP program coming through on the lending side of banks because they're the transmitter of it. And you can see that, well, relative to the money out there, the investment cycle isn't actually as robust as what could be, which tells you that even though we talk so much about excess savings and the potential for that to supercharge the consumer cycle, we may actually get a nice lift here as well from the business investment cycle. Not uniformly, as we know, there are really hard hit sectors of the economy, and those scars are going to stay inside that hospitality sector. However, other segments have a fairly decent step forward as we move through this recovery. So a couple of areas that could be quite optimistic as we move forward, but we'll have to see how it plays out. It would suggest that a lot of those PPP loans may have been used for precautionary purposes, not knowing what's going to happen next. And then there's the question of whether those funds subsequently get deployed or not. So if we move to the next cycle, let's get into the consumer side where all the action seems to be in terms of conversations. So this is basically capturing credit card and debit card data, the rate of spending that we're seeing in that area as consumers were getting those stimulus checks, and there was no hesitancy to spend the money. And what I'm showing you there is both low and high income individuals that are based off of postal codes. This is not our data, this is Haber Analytics. And it's showing you that the recovery has been broadly occurring. Low income folks have been much better placed to be able to spend, which is fantastic. They need to, more of their money is for like need to have versus nice to have, and we're seeing a positive impulse come through across the board. So we know that people are spending the money, and even though they are spending the money, there is still a savings rate of almost 14%, which is 2 times what it was before the pandemic hit. So there's still a lot of firing power in there, even though you see quite an impulse coming through in that second quarter. So that's impressive in itself. Where are they spending? That's captured on the next slide. And that basically says anywhere you can, whatever is open. So basically, restaurants and hotels have not been open. As they're opening, though, you're now starting to see that line get back to pre-pandemic levels. Not the case when it comes to entertainment, for obvious reasons, one of the hardest hit and still tightest restrictions. But if you're in the retail sector, clothing, technology, cars, everything else, very high level. So whatever's open, people have been showing a willingness to spend. And that's really good from a confidence and perspective of an outlook. Take a drink of water. All right. So does that mean that this will continue as we go forward? Well, as the economy opens, we expect there'll be a substitution effect. What you were buying to because you had no choice, that was basically where you could spend, will start to shift. So examples would be, instead of ordering food to your home, you'd rather go out for dinner. So that's an example. Groceries get substituted for eating out. So there's some of the spending increases we'll see will be substitutions, but others will not. Others will be net new. And the housing strength that you've seen has been critical to where we're seeing spending, and that's captured in the next slide. That's going to give you an idea of prices having been, basically, one directional in this cycle. Sales are coming down, but only because supply is so tight, there's not much to buy. But we're getting a big wealth impulse, meaning, people's equity values are up in the stock market, people's values are up in asset prices as related to house. So not only do you have a savings rate factor, which doesn't include wealth metrics, that's just your income flows, that's elevated. You also have elevated wealth. So we have these dual forces coming together. And what I put here on the right is just another example of where people are spending. Just like tourism has a high multiplier into the job market and to other segments of the economy, so does housing sales, because it fuels significant activity in renovation, formal renovation, like hiring a contractor or, do-it-yourself projects, and other related spending like appliances, furniture, and so forth, painting. So you can see how much of an impulse we've had on the consumption side there, and it lingers. So it's not as if you buy a house and you go and fill everything you need for it in the first month. Usually it's the opposite. It takes months and months. So there's long legs. So some of this reopening, we'll see some shifting of substitution to other areas, but some of it will be in some of these traditional areas. It'll stay there because they have longer legs as we move forward. So what if we get our forecast supercharged on the consumer cycle? And that's what the next graph is showing you. So just to give you a perspective, what we've done in our baseline forecast, Emily, if you can move forward just by one graph, please. Thank you. So what we've done in our baseline, which is the green line, is said, well, we're assuming people spend about 10% of their excess savings in the baseline forecast, and the rest is saved and goes to buy financial assets and pay down debt and everything else. What if we're wrong and they spend 25% instead of 10% over a 1 and or 2 year period? So that's what those other two lines are showing you, and the growth rates are captured in that box. If they spend 25% over a 1 year period, it starts to look like, you probably heard that the consumer cycle could look like post-World War II spending boom. Those are the growth rates that are hitting around 11%. Now, it's a bit of a leap of faith that people would be that aggressive with their spending initiatives, but it kind of sets the bar of where this can go in terms of maybe mirroring some historic periods, as well as the potential based on the amount of income that's out there. So lots of potential. Now, there is a fly in the ointment, and that's the job market, super important, which is captured on the next slide. Now, our baseline forecast, as you can see, which is that dark line, dropping down to 3.5%, does get us back down to pre-pandemic levels, fairly short order. We're talking about a year out, 2 years out, sorry. And so that's pretty good in terms of job market. That's a very tight level of employment. The composition of jobs won't look the same in all probability. So, there will be displaced workers. And it'll be a matter of how the Federal Reserve interprets what they're seeing in terms of the timing of rate hikes. So just to give you an idea, that alternate unemployment rate, this is the one, it's called U6, and this is the one where it captures, discouraged workers, part-time workers who want to work full-time, underemployed. And that's the one that the Fed is starting to more and more start to reference, that it remains elevated. It always remains elevated relative to the traditional metric. but it's elevated relative to its own history. And so that's going to give you the idea of, how much of this is a normalization or an absorption of people who are displaced. The other factor they're referring to is the participation rate. This is where women, racialized communities are really hard hit, even harder hit in the US than what we're seeing in Canada and Europe and elsewhere. So we're getting worse outcomes in the US in spite of this robust job market than what we're seeing elsewhere. So that will take a long road to normalize as well. And then the graph on the right gives you some components of the type of unemployment that we're seeing and how sticky it is relative to the pre-crisis level. So there's a lot of different things that the Federal Reserve can point to here to say, we're not comfortable raising interest rates because we're looking for more of a wholesome recovery, irrespective of what we see on business investment, irrespective of consumer spending. This is ultimately where it's going to come down to this, and of course, the inflation metric. So to get a little bit into that, we'll go to the next slide. This slide is basically showing you inflation expectations have crossed 2%. This is what the Federal Reserve wants. They want inflation to not just hit 2%, which is their target, but to be able to hold above it. What they don't want is inflation expectations to become unhinged and be too elevated. And I would probably place that elevated period. If we see numbers 3% and higher, there's going to be some red flags going up. Now, just to be careful, we are going to get base year effects over the next year because of really poor pricing last year. So they're not going to be concerned about a base year increase of 3% year over year. They're going to be concerned if they're seeing a broadening out of price pressures across services, across goods, and sustainability at 3%. That would clearly be an indication that inflation is probably hotter than they'd like to see it, and that would be certainly where they would have to move on interest rates. Hopefully you don't get to that stage because you could run into an issue with market expectations. So you would likely see rate increases occur before that would materialize, and that would help tap down those inflation expectations because they work as a dynamic. But you can see on the right, our expectation of the Federal Reserve is not their expectation of when they're going to raise interest rates. So right now, the Fed forward guidance, we'll hear later on today, but their guidance is the median consensus dot. It's showing 2024 as the timing of the first rate hike, although more and more we're starting to see those shifts start to try to pull into 2023. We think the economy will have significant strength and have a sturdy inflation environment that will allow them to start hiking by the end of next year. So we're well off of where the Federal Reserve perceives the rate hike relative to us, and maybe they have to go even sooner. But before they get there, they're going to have to reduce their asset purchase program. So that's the first leg that you would have to see happen before they move to a rate hike cycle. So the next graph is just going to give you an idea of the inflation period. So the reason I put this in is while we actually do think inflation will cross over and hold into a territory that will compel them to raise interest rates earlier, the challenge is we've been here before. So when we were in the post-2008-9 cycle, we saw inflation expectations rise, but then it didn't actually materialize in the actual data. Digitization, aging demographics, globalization, all these factors kind of tap down inflation pressures. And so what the Fed is saying, they're going to show much more patience because they want, basically assurance that inflation can actually hold at or above the 2% level. And so that little circle that the gold dot with the circle I have there, which shows you that, hey, we do have a period where 3% was the point I was making earlier. There will be base effects coming through. They will look past that. They're really concerned about the sustainability. So history has been in favor of weak inflation, and we need to kind of make sure we get the opposite coming through for them to be assured of a rate hike. And then, like I said, the balance sheet has to be normalized, which is the next slide. And they have yet to communicate this. So they are continuing to accumulate assets as if, we still have a crisis level outcome, and we don't. And so the balance sheet continues to grow. So the first step is for them to communicate a plan to reduce their asset purchases, meaning not continue to build the balance sheet, but at a slower pace, then cease asset purchases, then you move into consideration of rate hike cycle. So there's a few pillars that have to fall in place first. and before we get that outcome, and we'll see what their guidance is today, or maybe in 6 weeks' time, they'll feel more confident about making those announcements. Okay, so now, given I spent so much time talking about spending and fiscal, just a quick graph on the next slide. The most common question we get, who's paying for all this money? And so the next slide is saying, yep, debt risks are rising and debt servicing costs will rise. These are CBO estimates that were prior to the 1.9 trillion, so they're not even part of this. But what I thought I would show you here is a little bit of the dialogue and how complex it is. So let's start with the one on the right. The one on the right is like, hey, what if we get a 1 percentage point interest rate level that's higher than we're expecting or lower than we're expecting? And you can see how that shifts the trajectory of the debt as a percent of GDP. And so there's a lot of variance that can go in there. Now, what if you get that plus the one on the left, which is saying you could also get positive economic shocks, like the investment cycle has been so good compared to previous recessions, maybe we get a stronger productivity push than we're expecting, and that allows for higher growth rates than we had been expecting. And that's what that's capturing, that, you know, total factor productivity. If you get a positive shock versus a negative shock, we're more likely to go along the path of a positive shock based on what we're seeing in terms of digital adoption and investment levels this cycle, which makes it so anomalous to previous recessions. So when people ask, you know, where's the debt headed? You know, unfortunately, the answer is it's complicated because there's a lot of different trajectories. But the true test will come in 2030, because you see in all scenarios, you start to see that tilt up, right? Because that's when the aging demographics and the debt service costs really start to kick in terms of the dynamics. So that becomes a critical pivot point. And it looks pretty intuitive. No matter what scenario you're on, they're all rising. And so that tells you that in all probability, those tax bases are going to have to come up, which is my economist way of saying there will be likely have to be some degree of tax hikes or revenue expenditures quite extreme as we move forward if you want to level out those debt to GDP ratios, which, you know, really investors and financial markets tell you how they feel about your debt more than the general opinion of the population does, and that's what governments respond to. So I'll just quickly, on the last slide, is just on the US dollar. You might have been puzzled in terms of, you know, hey, we've got this fantastic growth coming through. We are world leaders on vaccination, and yet we've seen a currency that's been depreciating. And it's been depreciating against what we call your majors or your peer groups, advanced economies. And that's not a function of anything in terms of negative sentiment to the US. What that is a function is of the risk trade coming off. So, you know, when the world is uncertain, people run to dad, and the US dollar is dad and mom, right? They're the parents for safety. And as the economy has been improving, the vaccines have come to light, we've seen some of that trade come off. And obviously you haven't seen the same momentum in emerging markets because they carry so many more unique risks related to the recovery and being able to get access to vaccines and vaccinate their population. So what you're actually seeing is a reversion back to fair values of advanced economies against the US dollar, but not a sentiment of weakness towards the US dollar. So I just want to make sure that was clear. So I will leave it there. The last slide just gives you an idea of where you can find any and all of our research. It's all public. We don't charge, so feel free. And everything I've talked about is captured there in some shape or form for you should you wish. And so with that, I'll turn it over if there's any questions or however you want to go forward.
Wonderful, wonderful, wonderful. Please join me in thanking Beata. Thank you. Wonderful.
Thanks, John.
You're very welcome. Exciting, you know, a year ago, who knew that we'd be doing the same thing? You know, the pandemic would go on and on and on. My goodness. Anyway, there are a myriad of questions. I took copious notes. The questions are flying in. We already had some pre, so we've got to sort through some of these. But if I may, I'd like to start with one that came in from the audience.
Okay.
Have you been tracking any metrics on return to workplace versus remote working? And your thoughts on timing related to that? We're already starting to see that in Massachusetts as the mask and everything is changing here. So what is the new norm, or what the new norm might look like? And are you suggesting any best practices to look to as folks return to the workplace? What are your thoughts on all this?
I think, what we're seeing in terms of practices, and I don't want to speak universally, just what we're able to observe in the news and the headlines is businesses are approaching this very much similar to how governments are reopening, meaning they are bringing back their workforces in sections, so 25, 30, 50% on rotation, still some commitment to working from home with like a hybrid model of being in the workplace. And this goes back to my point that we're still in a very much an experimental phase of the effectiveness of the vaccines, the interplay with those who aren't vaccinated, and the interplay with any virus mutations and the effectiveness of the vaccine. So because of that, I think businesses are being a bit more cautious. As you may recall, some folks were already getting people back into the office last summer, and then we got that big wave and they had to shut it down. So what we're observing both with businesses and governments is more cautiousness on the approach this time around. And I think in part it's because people feel they maybe only have one shot now at getting it right. There's an issue of confidence, credibility, and obviously, especially as a business, you don't want to disrupt employees' lives who are sitting there trying to get childcare in place and then, not needing it and vice versa. It's a tremendous amount of stress. So what we're generally seeing is a gradual approach. How long that will last is an interesting question because, like I said, August, September, and into October become really interesting periods of whether your curves start to look like that Israel curve or it was like way down near zero on cases. That would suggest, okay, we can revert back. Businesses can make the decision whether they want to revert back to 100% in the office or not. But until we get to that point, it would be, I think, more risk aversion to go full board on bringing people back in place, which means that if that all goes well, we're really talking about 2022. It's probably a year where you're starting to see real vibrancy coming back into core regions that have big office and retail sectors. It doesn't mean it won't be evident now. It's just in terms of like full capacity and utilization, that's more of a 2022 story.
Right. Great. Thank you. But that means we can do the conference in person next year. So
yes, and I will gladly come down.
there you go. All right. How about commenting a little bit about this productivity? I want to stay on the same topic, the productivity boost in the US and Canada resulting from the work from home model. And again, because of that happening, will there be a lot more hybrid models? Or will it be, again, in January of 2022, everybody back to work? I mean, you think it's going to be more hybrid?
I agree. I think it's going to be more hybrid. One, trying to convince your staff they need to be in the office now might be a bit of a challenge, especially if you are one of those who are producing at a higher productivity rate. So the pandemic, not everybody does. But if you happen to be one of those teams, those workforces, areas of legal have done well in these areas, we've done well in economics, there's some benefits. And so there's some benefits from that perspective. The one area I would challenge is those who want to stay permanently at home. There is research to suggest that you get subpar results in terms of team dynamics, in terms of training, in terms of new employee experiences, them getting to know their colleagues, and in terms of informal learning, stopping in the hallway and having a chat or, being in the lunchroom, that type of thing. And so, each business will have to make up their own mind there. But that has certainly come through multiple threads and fairly universal in terms of doesn't matter where you work as an office worker. And so that would suggest that hybrid model may be around truer to form. The interesting aspect of the conversations we're even thinking about is, how do you make sure the hybrid model doesn't disadvantage those who are out of the office when you have some teams in the office? So what I actually think we should be thinking through is not that will we be full-time, part-time in the office or not? How do we as managers create an equal experience, no matter whether the staff is in or out of the office? Because you have to have a much more awareness and a seamless interaction with, maybe out of 10 people, you have a 5 and 5 split, but how do you hold a meeting and make the experience equal to the person at home as the one in the office? And I think that's the true challenge. that we're going to have to work towards, because right now the field's kind of all leveled. We're all working remotely, or all like, so it's very easy to have this experience when you're remote. It's different when you have different outcomes in terms of location start to come through.
I agree. You talked about inflation. You spent a good time on inflation. This weekend, I went to the grocery store, and I would say that inflation is much more robust than one would think. Just even the deli counter, it was double what it was just a few months ago. So you go to any retail location, we're seeing the prices have really escalated. Would that mean that the Fed will get more active? And you had talked about 2024, then maybe 2023. Well, maybe the end of 2022. But with this current feel, at least with inflation, what are your thoughts? Because it does.
Yeah, our view is it will be earlier. Like they're saying 2024, and we're thinking no, 2022, because our models are pushing through a higher inflation profile. Now, like I said, it's not 4 or 5%. It's holding at around 2.5%. But you have to be very careful as a central bank that it becomes unhinged, that you get too high up and then it takes work to rein it in. The one thing I would say, the worst case outcome for the Federal Reserve is that they get behind on the inflation curve and then have to hike more aggressively than they plan, because we all know as a business that could be disruptive to have a faster pace of hikes as opposed to something gradual, and you can observe the behavioral changes of businesses and households over time. So that's a reason not to wait too long, as we move forward. But like I said, we're definitely seeing pockets of inflation, like you mentioned. Meats and lumber is a really good example of what's happening now, housing, commodity prices in general. The question is whether that's going to be sustained a year from now. And the reason I say that is because this pandemic causes shutting down of activity, capacity and supply chains were so disrupted that it will take time for those to re-expand out. And they don't want to raise interest rates because of a temporary supply chain disruption, because that the interest rate becomes permanent, has a long impulse function on the economy. So what they're looking for is, what that we're seeing is demand driven, a demand push. And that's where you have true inflationary pressures, not because your demand is running ahead of supply, but supply is going to catch up if you just give it another 6 to 12 months. And so that's really, it sounds easy, but it's really tricky as you try to dissect the data to get a sense of where the supply and demand side. On the commodity side, there's a bit of a supply side factor now feeding through. Obviously, lumber is a key one. That may resolve over time as we go forward. But frankly, when it comes to housing, builders have been complaining for some time about high costs. And so that's one that seems to be sticking around, to your point, that some of this has a little bit of resilience to it.
Yes. Yep. Speaking of housing, you talked about that. We've seen it just here in New England, where people are moving out of the cities, moving out of downtown Boston into the suburbs, out of Toronto, going wider. And we're seeing huge escalation in housing prices. In my town, they're getting in bidding wars for homes.
Yeah.
It's crazy. It's counterintuitive to where we are economically, right? So I think it's a two-part question. One, this can't be sustained, and isn't it a little bit counterintuitive to what's really going on, because we haven't fully recovered yet. So your thoughts on all this? Yeah,
so it tells you an important monetary function still works. Low mortgage rates work. They work to compel people to go out and get off the sideline. And what we had seen before the pandemic, I call it the clash of the titans. Baby boomers and you have your millennials, these two really big age cohorts. And then the boomers don't want to get out of the house, and the millennials can't push them out of the house. And so you always end up with this supply mismatch with these two big demand forces demanding homes. And then that got supercharged from the pandemic, especially with the millennials, who are now, I don't even know if millennials know this, they're not that young anymore. They're in their 30s. And this is the time in your 30s where you get the biggest jump up in home ownership rates for obvious. buying residences. So we have a very sharp supply shortage happening in the US. We see the exact same dynamics in Canada, even worse in Canada. We would love to see, you know, when we see US prices at, you know, year growth, that is a calm market for Canadians. They're looking at 30% price growth. They've been in a bidding war well over a year. Things are going for not 200,000 above ask. It's a real wild market out there. We see a little less of that but happening in the US, but not to the degree that you're seeing already in Canada. But both of these markets face very tight supply. People not wanting to put their homes up because, you know, one, you don't want people walking into your homes during this particular period, but also where are you going to go? There's not much supply out there for you to go to. So what higher prices do is start to compel people to get their listings up and put more houses on the market. So we're seeing that dynamic happen in Canada now. We're not yet seeing it happen in the US, but it should, because that price point is getting to the point that anybody who was thinking of selling within the next year, probably now is a good time, and they'll start to think to put their house on the market. So that's one factor. What I find interesting, John, is that the new housing market is actually seeing price declines on a year-over-year basis, new builds. And that's a little bit deceptive because it's occurring because the size of those units are getting smaller. So what's getting built is getting smaller because the cost of building is going up. So it could get mismatches. Even though there's building happening, it may not be to where people want it, and you still get a supply shortage. So it's fascinating in terms of very different dynamics than the 2009 period where we could not get the housing market to reignite. And this one's certainly showing all its colors and then some. So it's a positive dynamic. It's what you need for recovery. So it's very positive that it's there. However, to your point, it can't last. Affordability is eroding, and that will start to take a toll.
Yeah. Well, we are in New England. We are the New England Canada Business Council. And so we've got a question wrapped around, and you talked a little bit about it, about the border and the border crossing. And let's talk about the economics associated with it. Because again, 5 of the 6 New England states, Canada is the #1 trading partner, 5 of the 6 New England states. So the question is tourism, as you just talked about, is such a big number here in New England from Canada coming into New England. Will this region lag compared to the rest of the nation? Will Atlantic Canada lag compared to maybe Western Canada? Will this whole Northeast corridor lag because we are dependent on one another? So what are your thoughts there?
Yeah, it's a good question. It's certainly possible because, again, this gets to the point that we're not even at the stage, at least publicly, it might be happening privately between Washington and Ottawa, but publicly we're not at the stage where we're hearing about the timing of the reopening of the border. But yet in the EU, for example, they're saying, hey, let's let vaccinated Americans in. This is fantastic, right? We're not having those conversations yet in Canada. And so while I think the US would probably be more willing to open the borders to Canadians who are vaccinated, we're not there in Canada because the vaccination rates haven't hit a critical mass. And to open up tourism, and then the staff would not be vaccinated that are serving that group of people, right? So there's complications in doing this. So I think it's a valid question, and like my instincts suggest that you could see lags there. But sometimes governments get creative, and so I'd be curious to see if maybe the discussions go this way. Maybe if you're on the state side, you could think through this, whether we should be forming some bubbles. So, you know, like as you probably heard, the Atlantic bubble in terms of, you know, movement within a bubble. Maybe there should be something happening at the border level on bubbles in terms of who can come back and forth and access their property, and vice versa. A lot of Canadians would like to get back to Florida at some point. My parents still have their golf clubs there for a year. So there's just as much eagerness to go the other direction, I can assure you. But there's a couple of ways to play this out. I think that, you know, I had mentioned that September deadline.
We lost you. We lost your volume here. We lost you. And are you back? Keep talking.
Can you hear
There
me?
you go.
Yeah?
You're back.
Oh,
Thank you. Thank you.
I was just saying there's going to be a lot of pressure over the summer to get these borders open. So September is probably the end point, but maybe we see some movement in the summer.
Awesome. Well, everyone, my goodness gracious, I guess can we all do a big round of applause? Yada, thank you. Thank you very much. Just an outstanding job. Outstanding. And it's so good to see you. And a big thank you to TD for being such a large contributor and sponsor for our event. So thank you very much. Thank you.
Oh, my pleasure. It's always fun. Thank you.
Thank you. Okay, folks, we are on to a short break as we bring the other folks aboard. And again, want a big thank you to our sponsors, TD, which is a platinum sponsor, as we talked about. Big thank you to TD. And again, Rasky Partners, Comcast, Deckert, TMX, A2C, all gold sponsors, our premier sponsor, John Hancock, and our associate partners, Connect and New Hampshire Business Association. Again, a big thank you to TD, a big thank you to Beata. Wonderful presentation, and we're excited about our next panel. And we will go live at 2:05 in 3 minutes. Thank you. Well, once again, I would like to welcome everybody to the New England Canada Business Council 2021 U.S.-Canada Business Economic and Trade Executive Forum. John Sorensen here. I am president of the New England Canada Business Council. And again, a big thank you to our sponsors, as you see them up there, TD Bank, Rasky Partners, Deckert, TD being our primary platinum sponsor, and again, our gold sponsors, Rasky, Deckert, TMX, A2C, and Comcast. And again, we have John Hancock and Connect and BIA are partners from an association perspective. So a big thank you to our sponsors. We're on to our first panel. Very, very excited about this. We have three outstanding CEOs. One of them, a good friend of mine, Brooks Tingle. So we're excited to hear from Brooks and John Hancock But to start us all off, we have our moderator, Chris Harvey. Chris, are you ready?
I am ready. Thank you, John. So hello, everyone. I'm Chris Harvey. I'm a partner at Deckert LLP, where I'm a global co-chair of our financial services group. Pleased to be your moderator today. We have a group that consists of 185 lawyers, 9 countries, 15 offices around the world, and we represent a great many global financial institutions. And I'm pleased to say, including 2 that are represented on this panel, Manulife, John Hancock, and also Sun Life. And we are keenly interested in developments that affect global financial services. Our panel today is titled The Executive Fireside Chat, and we're going to talk about the success of the financial services industry in an innovation-driven ecosystem and a very evolving regulatory environment. So I'm going to just introduce our 3 panelists today, our 3 CEOs. They are Brooks Tingle, President and CEO of John Hancock Life Insurance Company, Dr. Daniel Fishbein, President of Sun Life US, and Peter Lindley, President, CEO of the Ontario Pension Trust. I'm going to ask each of them to kick this off by expressing their views on the subject matter of this panel. We then hope to have an interactive discussion. And I do want to remind you, we welcome your comments and questions. There is the Q&A button at the bottom of your screen. So please do send those in and we'll try to get those addressed. I think I'll start off, Brooks, with you. If you could take the floor and tell us what you see for innovation and regulatory change in the financial services world in this sort of cross-border environment.
Great. Thanks, Chris. Thanks, John. Great to be with you. I have a few slides I'll run through. Just really want to start by acknowledging and thanking the New England Canada Business Council. John Hancock is the U.S. Operating entity rolling up to Manulife Financial, our global parent. So with John Hancock based in Boston and Manulife's global headquarters in Toronto, it's natural that would be closely aligned with New England Canada Business Council, and the council does great work. So thank you. So Manulife, John Hancock, been around an awful long time. Hancock founded in 1862. We offer a range of financial services products. Globally, we offer everything from health insurance to we have a bank in Canada, group benefits, a full range of financial services products. In the US, we have basically 2 core segments: our wealth and asset management business, offering mutual funds, ETFs, 401ks, things of that nature, and then the insurance business that I have the opportunity to lead. Given the theme here today, I thought I would quickly run through a little case study involving the life insurance industry. It's one of the businesses I lead here, and for any of you in our audience that have ever purchased life insurance or own individual life insurance, you know that it's a space that's just absolutely ripe for innovation. And I'll lead you through a quick little innovation case study on that. So if you think about the life insurance industry, and again, I'm sure it's an industry many of you do not think about every day, but there are a lot of things that have been great about it. The financial strength, the reliability, as I mentioned at the outset. Our industry has been around hundreds of years. Manulife and John Hancock have been around well over 100 years. The solutions we offer are absolutely essential. If you've ever known somebody who's experienced an unexpected death, you know the consequences of not having enough life insurance for their family members and others. And the peace of mind that comes from having life insurance is unquestionably a positive. So there have been some great things about our industry, but if we're candid, sitting here in 2021 and amidst this, modern sort of digital revolution and digital economy, there's a whole bunch that hasn't been great. You have to be really charitable to call the life insurance industry innovative. Buying life insurance, I would argue that in a world of one-click buying on Amazon and all that, I don't think there's a product left in the modern economy more difficult to buy than life insurance. We like to joke that buying a home is difficult, but your realtor doesn't generally ask you for your blood and urine. Our industry does. And then lack of ongoing customer engagement once somebody has purchased the product. It's hard to think of a a product less engaging than life insurance. You buy it, you tuck it away somewhere, maybe you pay a bill once a year. The company might send you a privacy notice once a year. But again, in a world where we all have multiple smart phones and devices and appliances are smart, some people drive smart cars. We just didn't think that we could afford to continue to offer a product that's terribly difficult to buy and not at all fun or engaging to own. So we have a really simple view of the future for the life insurance industry. It's that it should be easy to buy and yes, fun to own. I'll tell you a little bit about how we're doing that. On the buying process side, again, anybody who's ever purchased life insurance, no, it's just one of the worst processes, right? We literally grab fluids, blood, urine, what have you. You oftentimes have to see a doctor or have a paramedical examiner show it up in your home. You have to fill out a very lengthy application. Historically, life insurance applications historically have averaged like 33 pages long or something. And it's a very lengthy process. From the time you say, hey, I'm going to buy life insurance to the time you get that policy and coverage in effect is typically, or has been typically, several weeks. So we're investing a great deal to transform that into a process that is non-invasive, is fast, and is very convenient. And digital really enables all of that, starting with electronic health records. Most all of us as consumers today, through our doctor's offices, have an app through which we can access our medical records. Rather than asking a client to go see a doctor just for us, complete a bunch of paperwork about their health, if they're willing to, on a one-time limited use basis, share access to the electronic health records, we can do what we need to do almost instantly. Digital application process, asking each client only questions that are relevant to them, and then convenient electronic delivery process, a lot of use of digital, as I've said, and advanced analytics along the way to personalize and customize the buying process for each consumer. So making it a whole lot easier to buy. And then once you own the life insurance, we've really done a lot to transform that. And we've introduced something called John Hancock Vitality and a companion product called John Hancock Aspire. I'll walk you through because they're really quite different. Just a couple words about why we did that. It really was driven by a set of values. When you think about who should care about you living a long, healthy life, I think it'd be hard to argue that anybody cares more about you living a long, healthy life beyond your immediate friends and family than your life insurance company. For those that don't know, that's how we make money. You buy a policy, you pay us premiums, we invest them. The longer you live, the longer we have to invest those premiums and make money. So we thought it was sort of profoundly odd that for hundreds of years, our industry would issue coverage on people, sit back and say, sure, hope that person lives a long, healthy life, but do nothing to help achieve that outcome. We're changing that. Now's the time, because longevity, really to the greatest extent in human history, can be influenced by choices we make, nutrition, exercise, seeing our doctor or not, things like that. And we have relationships that average, decades with our customers. We paid a COVID-19 death claim recently where the customer had been a customer for 94 years. Parents bought the kid a policy when he was born. He died at 94 from COVID. And then what a great lens through which we can create a different engagement paradigm with our customers. Rather than just sending them a bill once a year, let's actively engage them, incentivize them, reward them for steps they take to live a longer, healthier life. So let me quickly tell you how we do that. We do that through a shared value model where if our customers take steps to live a longer, healthier life, our mortality results improve, we make more money, we take a big chunk of that and plow it back to the customer in the form of premium discounts and other rewards that I'll get into. It creates a wonderful sort of virtuous cycle. So how does this Vitality program work? You get a life insurance policy from John Hancock, you download an app, we offer you a free wearable device, a free Amazon Halo or Fitbit, or you can participate in earn a free Apple Watch program. You then start doing things that correlate with living a longer, healthier life. Take a certain number of steps a day, work out in a given day, buy healthy foods at the grocery store. We have an arrangement with 17,000 grocery stores nationwide and an app where if you buy healthy food at one of those 17,000 grocery stores, you get 25% off your purchase and you get points for having bought healthy food. You get points for seeing your doctor for preventative screenings, things like that. We now offer points for a good night's sleep, for meditating, a whole range of things. You earn those points for doing things that correlate with a longer, healthier life. they accumulate and you get a status. I'm not unlike a frequent flyer program or something, bronze, silver, gold, and platinum. And that status level determines and drives the level of premium savings you enjoy and the value of a whole range of other rewards and benefits that you get from our program. And just to give you an example of those, I mentioned the healthy food discount up to $600 in savings at the grocery store each year. If you're at the highest status level 3 years in a row, free Amazon Prime membership, up to 50% off booking hotel stays through hotels.com. And probably the thing that customers enjoy the most is actually this game. We have 2 games embedded in the system. One is every 10 workouts you complete, you get to spin this wheel. You see it on the lower right-hand corner here. You may get $5 at Amazon, $10 at Starbucks. Wonderfully popular feature. But the point is engaging our customers, working with them, incentivizing them, rewarding them for living a longer, healthier life. And the net of all of this is we've gone from interacting with our customers once or twice in a boring administrative way to 20 to 30 times a month in a positive, engaging digital manner. So old way for life insurance, complicated, difficult to buy, to easy, minimally invasive buying process. The 1 to 2 interactions a year that are boring, administrative that I mentioned, to dozens and dozens of positive interactions. Literally, our customers are thinking about us when they're checking out at the grocery store now. Before, the industry hoped people lived a longer, healthier life. Now we actually engage them to achieve that outcome. Before, life insurance was primarily, the value was primarily realized at death. Now, lots of value conveyed while living. So anyways, just a quick case study of the type of transformation that I think the insurance industry broadly needs to undertake. And I look forward to participating in the discussion shortly. Thank you.
Great. Thanks, Brooks. That was great. Next, I want to turn to Daniel Fishbein for the Sun Life perspective.
All right, thanks a lot. And it's Dan, by the way. Happy to be here. This is an organization I haven't had the chance to interact with before, so I'm really delighted to do so, especially with the commonality that we have. As I'm sure most people know, Sun Life is one of the largest insurance companies in Canada, but we also have a large US business that is headquartered in Wellesley in the Boston area. So we certainly have a very strong New England Canadian tie. I have a couple of slides as well, but I'll first give some quick overview on Sun Life and especially Sun Life in the US, and then also, as Brooks did, talk a little bit about some ways that we're addressing the innovation challenge. So Sun Life was founded 156 years ago. We entered the US 126 years ago through the state of Michigan, and we moved from Michigan to the Boston area about 50 years ago. And I've been asked why, and actually I'm not exactly sure why, but if you look at quotes from the time, the leadership felt that Boston would be a better location for a financial services organization, especially for access to talent. Sun Life globally is in 4 major businesses. Our Canadian home market, where we're a multi-line insurance company. We're in Asia, where we do business in 8 countries. We have a US insurance business, which I lead, which I'll talk about in a moment. And then we also have a significant asset management business. Coincidentally, our asset management business is also headquartered in Boston. That is MFS, which is in the Prudential Center on Huntington Avenue. In the US, we have, our history, I mentioned 126 years. That history, for most of that time, Sun Life was a retail insurance company, a retail financial services business. We offered individual life insurance, in more recent decades, annuities. And then since the 1930s, we've also offered group benefits. Although for much of that time, the 2 primary businesses were individual life and annuities. Coming out of the global financial crisis around 2010, the company made a decision to move away from the retail businesses. So we sold the variable annuities business and we put the individual life insurance business into closed block status. We still have that individual life business, but we no longer sell those products, but we do serve about 100,000 clients. And at that time, our primary business in the US became employee benefits. And we've been growing our presence in employee benefits since it is our primary business ever since. And we play in the employee benefit space in several ways across the country. One way is in the group benefits, or sometimes called ancillary benefits space. These are benefits that are offered in employer workplaces. Those are benefits like group life, disability, absence management, voluntary benefits, dental, and vision. And we offer those benefits in 55,000 employer workplaces across the country. A second business that we have is called Full Scope RMS, which partners with 32 other insurance companies. And those are insurance companies that, for whatever reason, don't want to or can't invest in creating one of those products. So we partner with those insurance companies around any of the products that I mentioned, or most of them, in group benefits. And we help them run those products and share risk. And the third business, which has become our largest business in the US, is our stop loss and health business. Now, I need to explain a little bit what that is, because stop loss is not very descriptive, also not a very good brand name for anything. Nobody wants either a stop or a loss, but unfortunately, we have a product with that name. So in the US, health insurance, which most people, of course, get in their workplace, 67% of those Americans who get their health insurance at work are in what's called a self-funded plan. And what that means is the employer has hired a well-known insurance company, typically the same brand names, to administer their health plan, but they don't actually have any insurance. The employer is paying the claims directly out of their own funds, with the administrator doing that for them. By the way, most people who are in a self-funded plan probably, even though it's disclosed in their plan materials, have no idea that it's a self-funded plan. Now, many employers don't want to be completely exposed to that risk, so they buy a special kind of coverage called stop loss, where they are buying insurance for one person who might have claims over a certain what's called attachment point, or think of it like a deductible in 1 year. So for example, if one person has more than $150,000 in medical claims in 1 year, the stop loss policy kicks in. And Sun Life US is the largest independent provider of medical stop loss in the US. So through the stop loss product, and really more broadly through all of our group benefits products, we play a significant role in the healthcare space in the US. Now, in terms of innovation, I'm going to quickly mention 3 areas that we're pursuing. The health insurance and benefit space in the US is really built around health insurance. When an employer is thinking about their benefits program, because they spend most of the money, probably 90%, on health insurance, that's the first thing they're thinking about. Then they're wrapping these other benefits around that core health insurance plan. So the employee benefit space in the US is a very complicated ecosystem. It's also very, very large. The US spends $4 trillion a year on healthcare, and about half of that, or $2 trillion, is spent through employers. Put another way, the health and benefits space in the US at $2 trillion is larger than the Canadian gross domestic product. So it's an enormous, enormous market. And it is characterized by a great deal of complexity, many, many different players who play different roles. So one area of innovation that we have pursued is how do we interact very effectively with that complex ecosystem? Because that actually becomes one of the key differentiators. One of the ways we've pursued that is we bought an insurtech company in Boston 3 years ago called Maxwell Health. They were coincidentally in downtown Boston on Tremont Street, and they provide a platform that enables an employer to administer all of their benefits, including those we don't offer. So one way we interact with the ecosystem is by providing a platform for those of our clients who are looking for that. A second area of innovation is extending our reach. I mentioned that the health and benefits ecosystem is $2 trillion. While we're a big company, we play a relatively small role in an ecosystem of that size. But there are lots of ways we can extend our reach and do different things for the clients that we serve. So one way we're doing that is an acquisition we announced coincidentally last Friday And that acquisition was of a company called Pinnacle Care Management. Pinnacle Care is located in Baltimore, and what they provide is healthcare navigation for people who are faced with a sudden and serious illness. Now, you heard my description of what stop loss claims are. Those are generally large and therefore sudden and serious illnesses. So we can play a role by helping people navigate those very difficult situations, in addition to just reimbursing them through our stop loss plans. And then the final area is we have many investments underway in digitizing our capabilities. Now, I'll make a clarification. We are not a digital insurer. We don't intend to turn ourselves into a completely different, fully digitized model. In fact, the way we describe ourselves is as an expert model. People hire us for our people and the expertise that they bring, but we can make them available in much smoother ways, much more readily available to more people and more efficiently by digitizing many of the interactions that our people have with our clients. So we have numerous examples of where we're investing in digitization to improve our services. And with that, I'll turn it back to you, Chris.
Great. Thank you very much, Dan. Next, I'd like to turn to Peter Lindley of the Ontario Pension Trust for his perspective.
Good afternoon, everybody. Good afternoon. Thank you, Chris. Fellow panelists. My name is Peter Lindley, and as Chris mentioned, I am the president and CEO of OP Trust, which is the Ontario Public Service Employees Pension Trust. We are a jointly sponsored pension plan for the Ontario Public Service employees here in Ontario, Canada. I'm speaking to you from Toronto. We have over 98,000 members currently and assets of over 23 billion. So I think I'm quite different from Brooks and Dan in my focus and my area of expertise. And you might also notice from my accent that I'm actually from Old England, not New England. And so you might be wondering why I'm here on this panel today. Well, I have many personal links to both Canada and New England, which I won't share with you today. It's a story for another day. But the short story is that I moved here to Canada nearly 30 years ago. I've been working in the financial services industry even longer than that, but that's the short story. Prior to my current role as the CEO of OP Trust on the public pension side, and probably more relevant to today's discussion, is that for 15 years prior to this role, I was president and head of investments of State Street Global Advisors, based here in Canada, in fact, based in Montreal. And State Street Global Advisors, as many of you will know, is the investment management arm of State Street, who I'm sure you're all familiar with as the Boston-based custody bank. And Boston came something of a second home to me over the last 15 years. It's a fantastic city, and I've really enjoyed being there, making new friends there, and getting to know the city and the people. But in my role as head of the Canadian business of State Street Global Advisors, I headed a separate legal entity in Canada, but under operating and of course having to operate under Canadian law and Canadian regulations, but at the same time reported into the US headquarters. And so just want to talk a little bit about that as sort of talking about how some of the things that I've experienced in that role were really both very positive most of the time, but occasionally negative. Then I'm going to spend a little bit more time in the end of my remarks speaking more about some of the innovation that we're seeing in the investment space. On the positive side, of course, Canada and the US speak the same language. We operate in the same time zone, and we have very similar cultures. And while we don't support the same teams, we share a great passion for hockey. These positives fed into what were the main business advantage that we had at State Street in Canada, which was our ability to bring our global capabilities to our Canadian customers. And that really helped to differentiate us from most of our Canadian competition. Probably something that both John Hancock and Sun Life can appreciate as well. We found that the regulatory environments, while clearly not the same, had very similar cadence and changes happening. And one example of that was example, the anti-money laundering rules that happened while I was there. They went from being very soft and unenforced to being much firmer and harder, particularly in the post 9/11 period. But luckily, I think, and rightly, Canada and the US adopted very similar type approaches and similar implementation, similar times. So, we weren't disadvantaged in a way we could have been if the approach had been very different. And of course, being the same time zone, etc., technology was another area where we could leverage. And we use the same technology. And while we needed to occasionally offer a different landing page, sometimes in French as well, most of the back end was identical. So when we're language proximity and time zone negative, well, frankly, it was when there were economic or market headwinds. And it was often the case that in those periods, Canada was viewed as the head of the queue for reductions in staff and cost savings. Broadly, we were viewed as less core. In the traditional hub and spoke model, it was much easier to shorten the spoke and expand the hub. And this was particularly true post-global financial crisis. And the problem with that is that Canadian clients, I think, are slightly different than US clients in that they really like and I'm generalizing there about US clients, of course. I think New England's very different than other parts of the US, but my experience globally, in North America generally, is that Canadian clients are very relationship sensitive. And so they take a long time to warm up and can get very distrustful of American firms as a result, because they've seen it happen many, many times that American firms will come into Canada and then withdraw. And so that is an issue. And I think that is, again, we're talking about some of the differences and similarities between Canada and the US. There is a slightly different approach there. It takes years to build the trust with the Canadian client, but only minutes to lose it. So now that I've moved to the asset owner side at OP Trust, I do have a different perspective on things. Little background, at OP Trust, we manage internally the vast majority of our $23 billion worth of assets. After our Canadian investments, the US is, not surprisingly, the next largest country in which we invest. Not a surprise, as I say, because we're close. We speak the same language. There's well understood tax, legal, and investment rules and regulations that are similar enough that we very much can be aligned. And it's not different enough that we can't manage the differences. So we're going to continue to be working and investing in the US, but we are expecting in the long run the demographics and the growth in emerging markets. We're going to be investing more globally going forward. And that probably means we're going to reduce our allocation both in the local Canadian market, but also in the US market. Retirement is an increasing issue. Don't need to tell the other participants on this call that retirement in the developing world in particular, where we are aging and baby boomers are ready and can't wait to retire, but finding that they maybe don't have quite enough money tucked away to do so. At the same time, globally, we've all seen a reduction in the availability of defined benefit pension plans, and OP Trust is a defined benefit pension plan. And in one area, though, where there is still a very strong presence in these defined benefit pension plans is in the public sector in Canada. And in that area, Canadian pensions have a very different operating model, I would say, in my experience, than that in the US and other parts of the world. And it's often even simply referred to as the Canadian model, the Canadian pension model. It's based on a combination of independent governance and structures and professional internal investment management. Which means that we are arm's length or strategically different from the sponsors who are potentially politically may have political motivations and political challenges. By being separate, we are able to be independent and invest in different ways. We can also pay our people in a different way as well, because we're not technically public employees. So what that has led to, in general, and generalizations are always very dangerous, but in general, the Canadian public pension plan model has been, I'd say, very successful. And I'm extremely pleased to say that OP Trust is fully funded today as a pension plan and has been for 12 years in a row. So that's something you won't hear, I don't think, too many American public pensions being able to say. I'm also very proud of an innovation that has been made in the defined benefit pension space, which OP Trust has led. 18 months ago, we launched the first new defined benefit pension plan in Ontario in a generation. And we particularly targeted the non-profit network in Ontario, which is over 1 million people, which in Ontario is a big deal, maybe not such a big deal in the US, but 1 million people is a huge potential source of individuals who currently have virtually no retirement security. And so really we're doing this because we believe in the defined benefit pension model, but we also want to bring new members into our pension plan. And so far we've in 18 months, most of which was spent in a COVID period, we've brought in 46 new employers and over 1,500 new members. So that's an interesting innovation on the pension side. Other innovations, as we service our nearly 100,000 members, most of them now, even though they are retired, they're getting more used to using technology. So in the old days, they would get letters and they would hear from us once or twice a year, and they need to do transactions by writing letters and filling out paper forms. Now, similarly, we're trying to do more online with them. And at the same time, while we're doing that, we're also trying to help them with some of their financial literacy as well. So we're trying to bring them more help, understanding what I believe is a more complex world on the investment side. We do another area of innovation in the pension industry is both on the member side, but also on our investment side. So the other part of what we do, as I mentioned, is internal investment management. We've seen a lot of investment and innovation in this part of our business. One of these is in the environmental, social, and governance space, which is now a fairly common acronym of ESG. ESG in the pension world has gained significant prominence, and there's a number of pension plans globally, and especially in Canada, who have taken some very public stances on ESG. OP Trust is a long-term believer in this type of investments. But in recent months since I joined, we've expanded that role and given our team more responsibilities. But as an aside, one of the proudest days in my working career was when I was at State Street. And many of you may remember, it was a statue of a fearless girl that was unveiled on Wall Street. And this was a few years ago. It was unveiled by State Street. So not everybody remembers that. Most people remember Fearless Girl, but they don't necessarily remember it was State Street who commissioned it and did that. But it was part of our push to increase female representation on boards and in the C-suite executives of public companies. And what made me so very proud was it transcended the financial services industries. And I heard from people who had nothing to do with finance or the world of finance and saying, this is really important for our future and society, and it was just a very proud moment. So that's an example of sort of things that investment world can do to change the world. It's a very proud day for me. So our approach in the ESG space, as I mentioned, is to sort of really go a little deeper. And in recent years, climate change and diversity have increased in profile and importance. And investors like us truly believe that in integrating ESG into our investment strategy, as we are very long-term investors, we understand and believe that what is good for the planet in the long run is also good for our plan and thus our members. And so we've expanded our focus and resources and created a team who has the ability to actually invest. Now, in most investment organizations, ESG is seen as a risk management tool. We gave our team money to invest in innovative strategies that are at the intersection of innovation and sustainable investing. So things which could be like carbon capture technology, or different ways of evaluating or measuring carbon captures and other greenhouse gases, and trying to find ways that we can both do good, but also do good for our members as a result, because we feel that that's an area of significant potential future returns. Sectors like agriculture and forestry are amongst the largest carbon emitters, if you're thinking about it from the harvesting and cutting of trees and various animals and so on, create a lot of it, but they can also be unique in that they can contribute to a reversal through things like carbon sequestration. Another area of innovation that we have started down the path of at OP Trust is the use of artificial and machine learning. We started using that because we believe we can come with some better investment outcomes. And you don't have to look any further than some of the frenzy we saw in the GameStop stock earlier this year to see the ways that technology can impact the investment landscape. We believe the best ways to navigate disruption is through adoption. So we're using technology to stay ahead of the curve. We're applying artificial intelligence and machine learning in financial markets, but in a way that's really focused on risk mitigation to start with. So what can we learn from data in a very short period of time that can help us to avoid problems and reduce our exposures in a very timely manner? This is our first approach. So we're looking at things called reinforcement learning and uncertainty modeling, which is things I'm far from an expert on, but I'm led to believe that it's going to help us identify issues very quickly so that we can potentially change our asset allocation. So I've gone a little bit all over the place here, and I apologize for that, but I wanted to cover a whole range of topics that relate to both the Canada-US relationship, some of the things that I've learned from my experience in the past, but also thinking a little bit about the future and innovation in our industry. I didn't speak so much about regulations, partly because it's not very terribly interesting always, but also because as a pension plan, I haven't seen as many changes in the regulatory environment of late that create any either opportunity or challenges for us as a pension plan. So I'll pause there. Chris, I think you're on mute.
Yeah, great, Peter. Thank you very much. You hit on a lot of topics, some of which we're going to come back to, I think, based on some of the questions. I want to kind of turn to the more interactive aspect of this now and maybe start with a really big picture. We've had a huge administration change here in the US, going from conservative to something much more lined up with political views in Canada, I think it's fair to say. That would seem to bode well for US-Canadian relationships. On the other hand, this is an administration more likely to regulate financial services and tech, and implement pension reform. We've heard about the America Jobs Plan recently. There are some countervailing currents here. Maybe the stimulus package is going to have some beneficial spillover into the US, but it also creates some competition. Liberalization of immigration on, fintech and financial services employees, et cetera. I've thrown out a lot of topics here and hope that the panelists would take up areas of interest, but what can we expect going forward from a US-Canadian kind of financial services business relationship? Welcome anybody to jump in here.
Well, I think, I'm sorry, Peter, were you going to go?
No, please go ahead, Brooks.
There are a lot of factors swirling around right now. Looking at the U.S. part of our operation, and I'll talk about life insurance first, I guess. Bigger than anything going on with government, it's sort of an unprecedented time in terms of demand for life insurance. I guess nothing like a global pandemic and over 500,000 people dying of something that didn't exist or people weren't aware of 14 years ago to want people to run out and get life insurance. So we're seeing sort of unprecedented demand for life insurance. On the regulatory side, a couple things. For our business, we think about tax policy to start, and probably some headwinds and tailwinds there. There could be activity on the corporate tax side, but then there are some things that are, I don't know if they're probable or not, but possible for sure. Changes in estate tax limits, changes in marginal income tax rates, things like that, that would be actually quite favorable for the life insurance industry. People buy life insurance for a lot of reasons. At the higher end of the market, they buy it to pay estate taxes. And with the estate tax exemption for a couple, $23 million now, it's taken away the number of families that have needed that kind of planning. So I think like anything, there'd be some things that, giveth and taketh away, right? But I think net, we view the environment as pretty positive. We're regulated very differently in the US than our parent Manulife is in Canada, of course. When we're doing new things, driving the type of innovation that I highlighted in my opening remarks, I literally have people visiting 50 different states and a couple territories because we're regulated at the state level primarily. Yes, some things happening with respect to fiduciary standards and things like that at the national level, but the vast majority of our regulatory interactions in the US are at the state level. Different, of course, in Canada, typically more at the province level. So anyways, lots going on there. I'll defer to some of my colleagues to weigh in, but generally speaking, I view net everything together as pretty favorable climate right now, and optimistic about the future.
Sure. Well, if I could just jump in really quickly, I can tell you, and I don't want to make this a political statement, but I can tell you, generally speaking, Canadians are very happy with the change in regime. I think that's mostly because there's a much closer alignment in philosophy, let's say, with the Canadian spirit, with the democratic type approach. We're much more middle of the road type people, more mainstream. But also, I think things like climate. I just mentioned climate change in my remarks. I mean, coming out of the Paris Climate Accord was definitely viewed negatively by Canadians, and the last thing you want is neighbors who are not necessarily abiding by sort of the same emissions standards that you would like to be aiming towards. So you want to be aligned with that. So I think that's going to be viewed positively. I think climate is an area, hopefully, where we can use the emergence and recovery out of this sort of economic slowdown and crisis as a way of investing more in the climate type related spaces, whether it's sequestration or renewable energy sources or different, even just buildings with cement, which can absorb CO2, for example. Those kind of things are available. If that could be part of the recovery plan, this could be a sort of a win-win in my mind on the climate side. I think one of the other things changing, and I don't know if it's necessarily related to the change in administration there, but that we are seeing probably more to do with the pandemic, but reverses in globalization. And I don't mean that we've turned it around. We just maybe slowed down or halted the globalization trend, but we are seeing a little bit more localization, insourcing, whether it's of the ability to make your own vaccines, for example, which we didn't have in Canada, which explains a lot of the reasons why we're slower in our vaccine rollout than the US. But things like personal protective clothing, etc., we didn't have that locally sourced. We had to get it from China. So we're going to see, I think, some changes there. But I think that means probably for Canada and US, because we're globally proximate, while we may shorten the supply lines from Asia, we'll probably be doing more business between Canada and US, I would expect in the long run. So it could make us closer than we have and have closer ties.
And I'll just add one item. I think a benefit that Canadians have taken for granted for many years is having paid family and medical leave. Maternity leaves, for example, in Canada have always been much, much longer than what's available to Americans. So President Biden, in his newest proposal, which I'll talk about in front of a joint session of Congress tonight, has proposed a national paid family and medical leave program. As a disability insurer, that's actually very interesting to us and something we've been quite involved with, because that actually is a product we could provide, and if there's a private option for that product. So it's something we do well and we're interested in making available to more American families. We already make it available to our own employees, but this is something that could have a more profound impact on the economy and the workforce.
So just running with that theme and applying it demographically, one of the questions came up. We have millennials and Gen Zs and Gen Xers. First, they're used to buying products and services in a very different way than many of us are have been accustomed to. They are less inclined to go out and buy insurance or look at retirement contributions or variable annuities, they're more likely to be pushing for government supplied benefits. Where does all this go? What does this bode for pension plans, insurance companies, financial service companies?
I can start on the insurance side, and Dan can add a lot to this, I'm sure, too, because a lot of those folks I think are going to be getting these types of products through work. But for us, I talked to you about that Vitality program we have, which is right up younger generation's alley, all digital, all powered by an app, incentives, rewards, games, discounts, all this stuff. I had the opportunity to be out on the West Coast speaking to a group of FinTech folks and VC folks a couple of years ago and presented on it. And the average age in the audience was probably 30, maybe early 30s. And after I presented, a whole horde of them came running up to me. Everyone had their phones in their hands like this and said, Tingle, I never thought about buying life insurance. I thought that was some product my grandparents had, maybe my parents, but I want that thing. How do I get it? Literally with their phones like this, how do I get it? And I touched on it in my remarks, but imagine me trying to put the best possible spin on the buying process where I said, because they had their phones, they thought they were just going to bing, bing, bang. Said, well, I'll introduce you to an agent and then they'll have you complete this application. Yeah, we'll need some blood and urine, don't worry. And a few weeks later, we'll let you know. And I tried to dress it up as well as I could, but every one of them just kind of put their phones away and said, yeah, Brooks, we'll follow up with you on that. Of course, none of them did. So that inspired, when I, again, in my remarks, when I talked about transforming the buying process, we have to make it more digital. We have to make it less invasive. I mean, again, if somebody listening to this is bored, heaven forbid, listening to us, they could, while listening to us, order almost any product imaginable online with a click and have it in their driveway tomorrow morning. We can't, as an industry, put people what we put them through for the buying process. So, and that particularly applies with that generation. But I'll defer to my colleagues.
Yeah, I could, our world in terms of offering employee benefits is very complicated because there's so many different constituencies involved. The employer is involved. They generally have a professional advisor or broker advising them. They usually have a platform that they've selected on which the benefits are offered. So for us, it means being able to interact with many different platforms and many different configurations in lots of different ways. Because when that buying experience does happen, which increasingly is digital or even mobile, we have to be able to be a part of that platform. Whether we're on the platform or providing the platform, we have to be interoperable and be able to be there. One other, I'll just put in a little Sun Life pitch. We introduced a new product about a week ago called Stitch from Sun Life, which creates the ability for an employer to offer voluntary benefits without any administrative involvement from the employer. So basically, they just forward a link to their employees and we do everything else. And that's really to answer exactly what the need that Brooks was describing, which is more and more, nobody wants to get involved in the administrative complexity, including the employer. And the potential member just wants to be able to do everything on mobile the same way that they order, socks from Amazon or a pizza from an online ordering site. So we're building out capabilities, and I'm sure everybody is, to be able to play more in that world.
Yeah, those sound like fascinating products. Hopefully some of those are going to be available in Canada, not just in the US, because that sounds great. I think you mentioned, Chris, the younger generation. I start to sound like my father when I say that, the younger generation, but people have different expectations, and I think there's a couple of those. One is that many that I've met and spoken to, they expect to change careers and jobs far more frequently than my generation and my preceding generation. So transportability of things is important from a pension point of view, which is quite challenging. Defined benefit pension, it's very hard to transport that. So that's a place where we see, while people that would be certainly something that the defined contribution, or I guess a 401k type product, is more transportable than the defined benefit pension. So we don't see as many people working for 25 years at the same company these days. I also don't think we, while our generation, I think, has been consummate spenders, starting though to see a little bit of more awareness, I think, from younger people that they do need to save money. I don't think they're expecting to be they have to do that. They have to get a good job and they have to save money. So we are actually starting to see more people looking in investment. When we see some of our younger members, and we're hearing from some of the younger people who are contributing to pensions, they certainly are doing that, and we're starting to see more of that as well. So I think that's a good thing. They're realizing that they're not going to be, and I think it's partly because they realize they're not going to, they're likely to live, many of them over 100 years old, so they're going to need to do something about that to save some money. So we are seeing those two things, but also as those of you who know Canada well, there is a lot more of a social net here, both on the healthcare side and I think on the pension side, from the federal pension plan here is relatively generous, and it's being expanded, and there are more options available, I think, here on the federal pension side than there is in the US.
Great. I want to go back just to a theme about COVID or global pandemic as a driver of innovation. We've all learned to do things differently in the last year. It's not just Zoom and Teams and WebEx. It's everything, how we market, how we engage with clients. We've had a border closure here between the US and Canada. It affects real estate outlooks and investing, savings rates, insurance claim levels, maybe mergers and acquisitions, expansion plans. A lot of this is going to be permanent. Interested in any of your thoughts on that?
Well, maybe I'll talk about real estate quickly, because I think that's something that I tell you, I'm struggling with. So, returning to the office and work, what is the future of work is a big question on the mind of many of our employees, and that's certainly something that is transformed. And on the flip side of that, a large part of our portfolio, 13% of our portfolio, is invested in real estate and real estate-like investments. So we see both sides of this, both as a landlord, but also as an employer. So it is quite interesting. And on one hand, people, especially these days, well, we need more space and we need our own offices and we need HVAC, all these different things in the office. That's all extra value add stuff and extra expense from an employer point of view. But as a real estate provider, that's good news for us, because that's going to be, but on the other side, more flexibility, more working from home. And so let's say we're going to see probably an increase in the average footprint size per desk, per user, but we're going to have probably less of them, even though the workforce stays the same. We'll have more people working from home, say 2 days a week. And so overall, our expectation is there will be a reduction in sort of real estate usage by financial services organizations. For us, the good news is we had a significant investment in sort of industrial space, which is proximate to sort of downtown areas, and we've just seen that demand for that to be going through the roof. And a lot of that, of course, is things like delivery services from Amazon, for example, are taking those kind of spaces to help deliver mail order stuff. And what we were significantly underweight and had virtually very little of was the sort of the retail shopping mall type products. So that, relatively speaking, that real estate portfolio did extremely well in 2020. So just real estate perspective.
Yeah, I might add on a little bit to that, just in terms of our own experiences. We are very much seeing that the world has changed permanently. When we went home, which was Monday, March 16th, 2020, not that I remember the exact date, we were able to transition literally overnight to working virtually 100% from home. And we've had, with very few exceptions, all of our employees across North America, both the US and Canada, working from home ever since. And remarkably, we really hardly missed a beat. We had no reduction in productivity. We didn't have a ramp up time. People were up and running the next morning and have been running ever since. And that whole process has gone quite well. We've actually found that some things have worked better in this environment. Communication is better. We have a company where people work in many different places, and we've done a lot better through means like Zoom at having equal conversations where everybody's on the same footing. So as we're looking forward, we like to say we're not going back. People talk about going back to work. Well, we've been working ever since. We're not going back, we're going forward. And our future work is likely to be a very hybrid model where people split their time between home and office and use the office more for group activities and collaboration, training, and meetings, and do their heads down work at home. So what that's led for us from a real estate perspective, at least for our own employees, is we will still have real estate. We're not giving up on it, but it'll be less of it and very high quality real estate, because we want to make those spaces really attractive for when people need to use them or when clients might use them as well. But we'll definitely need less square footage because we think there'll be significantly fewer people in the office on any given day. And in our own business as an investor in real estate, we're taking that into account as well. We think, first-class central business district office space will continue to be very attractive. But there may be other types of office space that will be, less occupied in the future.
Yeah, just to close on that, I sense I think one never knows, and Peter, I'm sure, has professionals tracking this stuff much more closely, but my informal barometer of employee sentiment has shifted a bit just in the past couple of weeks. I don't know if it was hitting the 1-year anniversary of this, but I'm hearing slightly, but a growing number more people saying, hey, I kind of want to go back to the office. I think a little bit of the novelty is worn off, but I totally agree, Dan, that the industry has proven remarkably resilient. Part of what I said is great about financial services is that strength, resilience, really haven't skipped a beat. I will say it's tough running sort of an existing business is pretty easy, but when you're trying to do new things, innovate, ideate, form new distribution relationships, partnerships, it's a little more tricky. So I won't be surprised if we settle out. I mean, certainly there'll be more embracing of workplace flexibility as far as the eye can see, but I think sort of the rumors of commercial real estate's demise are a bit exaggerated.
Thanks. We have about 2 minutes. So I want to close with a question that kind of brings it back to the mission of this organization, which is, and just a quick hit answer here. I think you're all in a unique position to have a perspective on this. The advantages of being a Canadian company with a U.S. operation, being a U.S. operation, Canadian parent, and vice versa. Peter, in your case, with being a U.S. operation of a U.S. parent, what are the advantages of the cross-border relationship here?
I can start and just say that tremendous advantages. We've evolved, I'd say 10 years ago, the advantage of sort of diversification, business diversification, risk diversification. Now, a heavy emphasis on collaboration, leveraging of best practices, sharing ideas. I would say in my role, 40% of my time is spent on global matters, working with my colleagues in Canada and Asia, actively importing, exporting ideas and best practices. So a tremendous advantage.
Yeah, I mean, I think from the investment, I'll come at it more from an investment point of view. I mean, we continue to see great opportunities to invest in the US. And I think as we saw in the economic presentation, the US is going to recover well, recover more quickly. And we certainly hope that under the new administration, there'll be more leadership in renewable areas of investment. So we think that there's going to be some real investment opportunities in the US. And so we're going to continue to partner down with you folks and invest there, so for sure.
Dan, you have the last word.
Okay, I like to say that we get the privilege of being regulated by all 50 states and the District of Columbia and by OSFI. So all seriousness, a point I would make that's a big advantage for us, I think, is culture. I think we have a great culture, and some of that is being part of being a Canadian company, and there's a great spirit, great collaboration. People want to see each other succeed. And that helps us be a great place to work and to attract top talent. So I'd say culture is a big benefit here.
Great. Well, I want to thank my three panelists and thank the audience. And I'll turn it back to you, John.
Thank you.
Chris, wonderful. Thank you very much. Chris Harvey, great job moderating the CEO Fireside Chat panel. Thank you. Thank you, Peter. Dan, Brooks, thank you very, very much. Outstanding job and way to kick this off on our panel discussion. So thank you again. Appreciate it. We are going to take a 2 or 3 minute break. But before we do that, I do want to thank some board members and some administration folks. Number one, Leo Desjardins, Len Gold, Tom Kent, Tim Egan. This event would not happen without those fine gentlemen and all their efforts that they put forward. So thank you, thank you, and thank you. From our administration staff with McKenna, Susan Barber, outstanding job, and Emily Clifford has really been great on this technology side. So a big, big thank you to our administration staff and our support with McKenna Consulting. So thank you again. And you have heard about our sponsors. We'll put that back up here for a moment, and we will see you in about 2 minutes. Thank you. Welcome back, welcome back, welcome back to the New England Canada Business Council 2021 U.S.-Canada Business Economic and Trade Executive Forum. Big thank you to TD Bank and Beata, who just started off with a wonderful discussion about the economy, both the U.S., Canada, and of course the Northeast region of both the United States and Canada. It was dynamic. We had a great CEO panel, and now we're off and running into our FinTech technology innovations in financial services and their impacts on the future. So again, a big thank you to all for attending today. We have, again, we're blessed. This is a dynamic conference and a dynamic panel. And to start us off, we have a dynamic moderator. Please welcome Craig Spitzer, CEO of A2C. Craig, you ready? Oh, you're on mute, my friend. There you
Sorry
go.
about that. There we go.
All right.
I am ready. Thank you.
you.
Now I'm ready. Thank you very much. I appreciate it. I appreciate you. I appreciate Tim Egan and Leo Desjardins inviting me along with the board and TD Bank. I believe a lot of the topics that we'll go through kind of are related to what you guys spoke about before, which is interesting and provides, I think, for a good flow of discussion. I have a light agenda to go through, and then everyone can kind of add their value as we go along. I appreciate everyone who's coming in, who came in, and why don't we start off with introducing everybody. I can give a quick about A2C. I'm again the CEO of A2C. We are a cloud, a data, and an IT consulting company. We do a lot of work in fintech, and so a lot of the topics that we'll go through, we've done some work on. Starting off on our board, we have Greg Wolf. Why don't we have you say a few words about yourself and some of your experiences inside of this fintech world, and then we can get to some specific questions once we get through our board introductions, our panel introductions.
Yeah, good afternoon, everybody. I'm Greg Wolf, founder and CEO of Fiverity. Thank you, Craig, for the introduction, and thank you to NECBC for having me here today. So we're a fintech company focused on cyber fraud, and we're in a fortunate position to, we're an AI ML company, so we use advanced technology in the space. And we're in a fortunate position to be working with not just banks, credit unions, and credit card processors, but also members of the government. And we have operations and customers in the US, and we're also working with a partner in Canada to bring our solution to the Canadian market. So this is really right on point for us and very exciting to be part of this today. Thank you.
Thank you. Why don't we then move over to Leonard Gold?
No, I think you want to go to your panel. Matt and Greg. Robert.
Yes, okay, I'm sorry. Robert Morgan?
Great, thanks, Craig. I'm Rob Morgan with the American Bankers Association. I lead our Office of Innovation. For those of you who aren't familiar with the ABA, we are the trade association that represents the banking industry in the US. So all 5,001 banks is our constituency. At the Office of Innovation, our goal is to help make sure that our banks have a policy and legal, regulatory, and business environment that helps support innovation. So we do work in really three main areas. The first I will put is sort of public policy, trying to create good policies that promote innovation, allow banks to adopt new technologies, and better work with startups. The second piece that our team does is provide strategy resources and partnership guidance to our banks. So we help our banks understand how the market is changing and where the opportunities are, and help them find the fintech companies that can help execute on that strategy. And then the third piece of what we do is venture investing. So we participate in a number of professional funds and also make direct investments ourselves in areas we think that there is additional capital needed to help drive bank-friendly innovation and new technology. Looking forward to the discussion.
Great, thank you very much. And Jennifer Reynolds?
Thanks, Craig. Yes, so Jennifer Reynolds, I'm with Toronto Finance International. We're a public-private partnership between the financial services sector in Canada and the 3 levels of government. And so our organization, the mission is twofold. Number one, to promote the Canadian financial sector globally and the Toronto Financial Centre globally, to drive talent, investment to our market. And then domestically, we're focused on issues which go to the growth and competitiveness of the industry. So clearly innovation, fostering a robust fintech ecosystem is critical for the financial services sector. So we spend a lot of time, whether that's from a regulatory policy perspective weighing in, whether that's making sure we've got the right capital flowing to the fintech ecosystem, helping to make sure there's collaborations and partnerships happening between the fintech community and the larger incumbents. We weigh in and try to make sure that we're helping to foster that innovation ecosystem. And we also, on other fronts, in terms of growth and competitiveness issues, I would certainly say we're very focused on driving the growth of sustainable finance in Canada, and clearly fostering a great talent pool for the industry.
Great. It's a lot of subjects to go back to. And Matt Minatola.
Hey, Craig, thank you for having me. I am Matt Minatola, and I am responsible for all technology for E-Trade Financial. It is a retail trading platform and all of the services and capabilities that go along with that. As such, we are, in order to deliver that end-to-end service, we are partnered with dozens of suppliers, partners, fintechs, services, name it, in order to create that integrated experience. And so I thought today's topic was great in order to be able to kind of talk about all the opportunities that technology is starting to put in front of all of us, as well as some of the challenges that we're going to face as we look to integrate some of those things. So thanks, Craig.
Absolutely. Thank you, Matt. And thank you, everyone. I think that we've hit everyone. Is Susan Barber on here as well, or?
Yep, she's supporting you. So full steam ahead.
Perfect. Fantastic. So why don't we get to some topics here? Clearly, security is priority in today's world. So aside from specific security issues, which are interesting, but not as really specifically relevant to everything we're talking about, why don't I throw out to the group, and I think that everyone will have some similar and some different answers to these. What fintech, what financial technology are you looking at now that you were not looking at a year ago? And that may morph into one of the other questions I was going to ask, so maybe we can put that together. Is this whole COVID challenge has turned everybody's engagement model to really either completely digital or at least somewhat digital. What types of technologies, in the same vein as the first question, are you looking at now that you weren't really thinking about a year ago?
Well, as the technology company in the room, I thought it might be helpful actually to just do a kind of a brief overview of the technology platform that we've created to address digital transformation and specifically some of the security concerns around that. So if that would be amenable to you folks, I'd be happy to just give you a quick walkthrough.
Let's have it.
Right. Okay, how's that screen share working? Good. Okay, you guys see the screen?
Perfectly, thank you.
Okay, great. So as you mentioned, Craig, COVID has really accelerated digital transformation in the financial services space, and we work with banks, credit unions, and credit card processors, and they are really struggling to just come to terms with how quickly they can get online, given that customers don't come into branches as much anymore. The same token is a huge opportunity, right? Being able to have broader reach on a national or international scale. The problem with digital transformation is the Achilles heel, if you will, is cyber fraud. And cyber fraud particularly is challenging for financial institutions because they're poorly equipped to cope with sophisticated attacks. Particularly sophisticated cyber attacks, and these attacks actually cause billions of dollars worth of losses every year, and expected to increase significantly. An example of these type of attacks is synthetic identity fraud. So synthetic identity fraud is where hackers mine the dark web and they essentially obtain compromised identities and they cobble them together to create or fabricate fictitious identities, fake customer profiles designed specifically to defraud banks. And as you can see from some of these stats, this is a real problem, billions of dollars worth of losses. These numbers come from the Fed, who's really concerned about that. The chief problem with this type of sophisticated cyber fraud is that 85% of this type of synthetic identity fraud is actually missed and overlooked by existing legacy rules-based systems, according to the Fed. And the problem with that is it opens up the door, not just to fraudulent and massive losses, but also lots of nefarious activity in money laundering space. So enter machine learning and AI as the new technology, one of my favorite subjects. What we found was we created a platform which allows a human-in-the-loop machine learning algorithm to learn from the legions of qualified fraud experts in the field. So the day-to-day activities of a fraud expert as they're analyzing new account applications, loan applications, particularly in consumer credit, the machine learning algorithm learns from them through our proprietary technology and actually scales their know-how. And the key here is it's adaptable. Unlike static rules-based technology, machine learning can actually learn from the end user and be more effective over time. The other thing that we discovered, which is really key, so AI and machine learning is a key technology. The other one is around identity management. So what we discovered was that banks, credit unions, they want to collaborate in terms of sharing this, the known fraudsters, the patterns and identities. But of course, when you talk about sharing to banks and credit unions, the immediate response is, hold on a second, data privacy concerns, right? We can't just share data. We're obliged, to protect our customers' interests. So what we ended up doing is we built in some technology which allows secure data sharing of patterns and identities across multiple institutions. And essentially, when we did that, then the market said, this is terrific. This really helps us, this can solve a lot of problems for us. So this is how it works. At the bottom, we have this our platform overlays existing systems and data points within a financial institution, bank, credit union, credit card processor. And then level 2, we layer in this human-in-the-loop algorithm, which allows the system to learn from the analysts on a daily basis as they're doing their job. And then the key thing is we then expand it out to the community. So through the secure data sharing mechanism, we're able to leverage the know-how of the entire community and securely share data between them. And this methodology has proven itself in the last few months to identify 50% of the fraud that's being identified through our algorithm would have slipped through the cracks if not for this more advanced technology. And this has actually saved our customers millions of dollars, and it's a terrific way to move forward. So the final slide here is, the video, there we go. The final slide here is actually, what we found what was really exciting for me is the interest from not just the financial institutions, but from the government agencies, regulators and government and agencies who are really concerned about innovation as well. And the ability to essentially share data and share information across, oops, what happened there? To share information with the government agencies and have them participate in this initiative has actually been very exciting. One of the things we did when we started the company is we formed an AI think tank, and the goal was to engage with senior members of financial services institutions and understand what their needs were. And this landed up getting us connected with folks at the Fed, at the Mass Division of Banks, and a number of the OCC, the NCUA, to engage in their dialogue about innovation. And I think on a collective basis, this is a hugely exciting time for this type of technology. So much so that we actually culminated in a cyber fraud intelligence series that we just started this week, kicking it off with an exclusive interview with FinCEN. So overall, I think the technology is really exciting at this point, AI, digital identity management, and we're seeing a ton of collaboration as we build out the community solution.
I mean, that's a lot of information, and that's interesting. And that then can move into another question that might be interesting for Rob or Jennifer, or maybe both, is do you see any technologies that can assist with specific regulatory issues? It sounds like a lot of what your software does could probably be utilized for regulatory issues as well. I wonder if there's any specific fintech that those two are seeing specific to regulatory issues to make it easier to do cross-border business.
Jennifer, you want to start? Happy to jump in. Yeah, so one area we're paying a ton of attention to is sort of the reg tech space, right? And there's a whole industry of technology and new business models that have built around trying to make regulatory compliance easier. So, you know, traditionally as our banks have looked at it, right, there's always this tension between effective oversight from the regulators and the amount of work it takes to get them the data and resources to do that. So, you know, I think one of the opportunities and challenges here is that you really need to move in partnership with the regulatory agencies. But there is an opportunity, if you're able to do that, to create technology that can allow regulators to have better insight into the practices and positions of various financial institutions without the same sort of regulatory compliance burden that would exist in the past, right? So if you think about 5 or 10 years ago, to get better insight into how banks are operating, you'd have to add items to a call report. To, you know, often community banks on average have about 40 employees. So this is not a negligible burden to get new data fields, provide more often updatable data, and a better real-time look into those institutions. So we're looking at a number of different ways to automate some of that. So just a few examples. The FDIC, Chairman McWilliams has announced that she is looking for ways to digitize the call report. So they've started some pilot programs working with some of the core providers to help sort of automate reporting on an ongoing basis, right? The idea being that if you are trying to monitor for risk, checking in once every quarter probably isn't the best way to do that. But this has the potential win-win of making it so the banks don't have to create big cumbersome reports every quarter. So there's the ability to sort of build on that. The other area we're seeing a lot of progress from a reg tech perspective is in understanding the avalanche of new rules and regulations that's coming out. So there are a number of companies looking at AI and machine learning, particularly in the natural language processing arena, to help identify new rules and regulations that may be applicable to your institution so that you don't have to read through everything. And in fact, sort of route those rules and regs to the appropriate groups within the organization. So tons of opportunity there. I think it's a harder one to make progress because unlike other areas, you really need that the regulators to walk in lockstep with the financial institutions. But I think once we get moving, there's a ton of opportunity.
Do you think that the investment into reg tech, which I love, I had not heard that before. Do you think that the investment is going to flow in enough, because some of the business may not sound as shiny and exciting maybe, but certainly can be as big as anything. But as far as venture capital and private equity money flowing into it, that may be a challenge that maybe some government groups or agencies could assist pushing along.
Yeah, you know, I think it's not an area that we saw sort of the first wave of fintech investment really go into. We think about sort of the venture capitalists who invest in that really gravitated in sort of the first phase of fintech towards consumer-facing products, right? The second phase was a little bit more towards bank infrastructure. And now we're starting to see more investment move into the sort of less sexy spaces that really can move the needle across the organization. So I think it's coming. Certainly something we're looking at opportunities to help promote investment in and signal the importance to the market, because again, we think there's a ton of opportunity there.
Yeah, I mean, listen, in technology, the quicker that you could get your technology billed as a standard, the more money you're going to make, right? And so a regulatory issue, I mean, there's huge upside in that if you can hit the right one. Jennifer, did you have a thought you'd like to?
Yeah, I mean, I won't touch on the same themes that Robert brought up, that clearly very, very similar in the Canadian market as well. Reg tech, though, we've seen a tremendous amount of investment more recently in that area. So I certainly think there's a ton of opportunity, and smart fintech VCs are already jumping on that. The one other point I would raise around just security, and it's one thing that we've been thinking about for several years, not just with the pandemic, is do we have the talent? There's always a dearth of talent when it comes to cybersecurity people. So that's something that our organization has been very focused on. And how do you get university programs which are iterating faster and putting out the skills that the financial services sector is needing? So we've had several programs where we've actually developed programs with financial services and universities and colleges to get that skill set coming out more quickly in the market, because I think that's a critical piece to getting the right technologies.
Yeah, I agree. I agree. How about around data? Again, outside of security, what are maybe you could all go through some active projects that you're involved with that is slicing and dicing data, governing data, and allowing you to use your data and then the data that you get to collect from customers or whoever else to grow your situation.
So Craig, it's Matt. I'll jump on that because I think, Greg did a good job of talking about the challenges is to dealing with the day-to-day and people coming at you. And clearly the regulations within, needing to manage your business. I think one of the challenges, or one of the opportunities, I should say, that's coming up in the industry is, the consumerization of financial services, continues to accelerate, and the expectation of what someone has to be able to do online has grown drastically. If you just think about when you look at our business and you look at what the complexity of trades were on a mobile device 12, 18 months ago versus what's happening on a mobile device in 3 minutes, they're complex futures trades and, various other, there's all kind of things going on. And so what's happening and where our opportunity is those consumers are looking for that same experience that they had in a retail space or what they've become accustomed to in their day-to-day lives. And the challenge we've got is, how do we manage that data and analytics? How do we take that data and analytics and give our folks the tools and the ability to kind of mine that and glue it together with others, but yet be sure that it's secured and safe? Because clearly data security is important to everybody, but in our business, it is the lifeblood. You do not make that mistake. And clearly a fine is one thing, but brand risk is probably multitudes bigger of an impact. And so we've really, started to work both directions. We started to obviously, build out and do the security pieces bottom up, but we've also started to work back from the data and analytics piece and really start to rethink how we almost industrialize all the things that are going to be needed. So instead of having a tokenization solution or encryption here or making sure these things are there, we're really just rethinking our entire platform, from migrating it from EDWs and cloud-based things and PII data here to, we've got to basically have an ability to mine data, know where it is at all times, know where everything is, and be confident that we can glue it together and run and create the confidence that we need. And so I think that's a big project that's going on. And it's not a project per se, but it's going on in various spots across the bank.
I can add something to that, just to kind of throw the cat amongst the pigeons here. I'm involved in an initiative which is exploring open banking and how data access is being provided to financial institutions and to their fintech partners from the core legacy systems. And that is, I think, one of the single biggest challenges to innovation. And that is that whether the FIs are doing it themselves, and it sounds like, Matt, you've got a lot of interesting things going on in your environment, either within your organization or with partners, or whether FIs are working with firms like us. But there's this chokehold that legacy systems have over the data. And we've heard horror stories about vendors, large vendors to swaths of the industry who literally hold that data hostage and have exorbitant fees for the banks to get access to their own customer data. And that's a problem. I think that's going to be changing in the next few years. I don't have an answer for that. This was a question, but I do think that a shift towards more secure API-driven access to core systems versus what's currently in place, which is really kind of screen scraping, robot capabilities to connect to those data sources, will ultimately provide faster innovation and ultimately provide better services to the customers of banks and members of credit unions by allowing the financial institution to deliver more tailored products and services.
Yeah, thanks, Greg. Let me jump in there. I think you raised a really important topic, actually two topics I think we could go on all day about, the importance of the sort of core providers in the financial services space. It's something I don't think folks often realize. 90% of the 5,001 banks in the US rely on one of three companies for pretty much their entire technology stack. And I think you used the term legacy providers. I don't think that's far off. These companies have been built over time and typically operate on a very different model than we think of technology as today, right? They aren't the sort of API native open ecosystem. They're typically a little bit more walled gardens, long-term contracts. You hear stories of 7, 8, 9-year contracts. Imagine buying a laptop on a 7-year contract, right? The technology has changed dramatically by the time it's done. And one of the things we've been really focused on from an ABA perspective is trying to improve banks' relationships with those core providers. One of the areas that we've really identified is the ability of community banks to access their own data, to leverage that data and integrate some of these third-party fintech solutions. The ability to do that's really important. I will say I share your optimism that the industry is moving towards a more open API-based model. One of the companies we have invested in is a company called Finxact, which is a core provider with a sort of more open banking model, right? It's API native, allows you to plug and play and build the sort of pieces in that you as an institution want to build. Not because we think Finxact is the only answer, but because we think that that more open model is really critical to the competitiveness of the industry in the long run.
Yeah, everybody looks at
Thank you.
us as a kind of the fintech disruptor, right? But I think the real disruptors are going to be, the cloud-based modern technology platforms, either at a core level or at a services level in terms of products and services, which are going to shake up the industry. And it's already happening. It's like the back door is open with the screen scraping methodology. So, we're working with the regulators to see if we can come up with a more structured way to provide bumpers for that migration, because it's already happening.
So an interesting question in the middle of all this that is sort of relevant and getting much more relevant around every topic that we just hit. And maybe you could go back and ask and comment on how that relates to your thoughts about the next stage for cryptocurrency.
I'm just going to disclaim on that and say I'm an AI guy, not a crypto guy. I don't understand I played with blockchain. It's really hard, and I don't fully understand Bitcoin and its valuations either. So I'm going to punt that to somebody else in the panel.
Yeah, that's fine. Is there? Oh, go ahead.
I'm happy to give a quick opinion there. I think clearly there's a lot of activity in the crypto space. It's something that our banks are looking into. It is something that has sort of sprung up often in a less regulated arena, but as people get a better understanding of the technology, the strengths and weaknesses and risks, we're seeing it move over to more traditional institutions. And I think we're seeing a number of our members trying to offer crypto products to their customers. And at the end of the day, it's, the banks want to offer the products and services that their customers are looking for. So there are a number of ways where the market is developing. In some areas, crypto is being used as a sort of store of value, right? Digital gold. So in some areas, it's an alternative for that. In other areas, it is being used as a payments mechanism. I think we're seeing that a little bit less today, but there's a lot of discussion about the opportunity for blockchain-based payment systems to help add efficiencies to the market. And then the third area we're seeing in sort of the crypto use cases is the idea of utility tokens, where folks buy a coin on a network and use that for services on that network. Sort of a really easy way to track how much you're using services and novel ways to charge for them. So a lot of experimentation happening. From the banking industry perspective, I can say banks are moving slowly and methodically to make sure that they can offer their customers the appropriate protections, but increasingly looking for opportunities to partner and push forward. I'll close by just sort of flagging that there's a whole separate conversation happening on the idea of central bank digital currencies, one we're really engaged in, that is related in a lot of ways, but is looking at how to take some of the benefits that we think may be there in sort of the crypto models and apply them at a national level to help increase competitiveness and address needs within the financial system.
Great, thank you. Thank you. So Matt, I have a couple questions for Matt. As they say, full disclosure, I've done some work with Matt through the years, and he has been in front of many large financial situations of all sorts, from the credit card industry through all different types of credit and now in the trading world. What are your 2 or 3 big either discussions, suggestions, or maybe some food for thought around the data world that you're dealing with?
Yeah, Craig, I think we've touched upon, I mean, it's kind of interesting, no matter what question I think you would have asked, I think we all would have ended up in probably the same backyard, right? As to the challenges that are there. And I think there's a couple things that I'll bring it down a level or up a level. We talked about, the ability to secure your environment. Greg had talked about the fact of what his products do and where they're at. But then we talked about AI and we talked about other things. But I think the commonality on it is, I think in technology right now, the biggest thing that I've seen that I've been doing, and when we sit with our partners and other folks are doing, is these things that were spot solutions that we were able to get away with for years. We can't get away with them anymore. There's just too many contact points, right? You want a single pane, you want a single experience, and you've got to have an ability to make sure that it's secure and it's seamless and I can get to wherever I want. And so, again, not the sexiest thing, but really going back and doing some of that big kind of building that we should have been doing all those years. Those projects are starting to get traction. Again, Greg would tell you in the security world where you're starting to collapse and consolidate. We're doing it on the UI front, right? If you think about it, the ability to roll out new capabilities, new platforms, new apps, integrated apps, all that stuff, that has to be quick. And what we found was we were buying them and putting them in and using them and then building a layer, when in fact, I think we're now having to realize that if we're going to be successful in 5 years, we've got to start to figure out those critical points. And it really comes around security and the experience that I have as much as the security of it. I need to have a seamless, secure environment and be able to get to the data, whether it's my Amazon account, whether it's my bank account, whether it's whatever. And being able to build those services. And, we talk about the API layers in order to get there. But I would tell you, we're starting to really build around core services within our own environment that we are building out. And I'm the only one, but I see heads nodding on the panelists. I think you guys are kind of running into the same stuff. So I'll pause there.
Does the idea that people are doing a lot more on an iPhone from an app perspective change that, or just move it faster?
Just moves it faster. Just moves it faster, and it's not just an iPhone. It's going to be devices. I mean, the devices are multiplying by tenfold each year. Whatever the number is, it's massive. So the ability to get that data and mine it and to see it and to manipulate it, as well as there may be an experience that you have to deal with because someone's going to want to do some things with you in a partnership, and so that's what's spinning it probably as fast as we're seeing it. And again, it goes back to, again, Craig, as you said, we've done business, the ability to get a project or get experts in to be able to look at something and be able to then put a box around it and say, let's get this right so that we don't have to do it 7 times every time we do an integration.
And
One thing
the
I'd add to
world of
that
the
is
cloud. Oh, I'm sorry.
Sorry about that. Okay, just one quick thing to add to that. I certainly think it's been consumer driven in terms of this increased investment and finally doing these bigger projects that needed to happen a long time ago. They're finally getting traction. But I think the other element too is from a risk perspective. You've got to, the regulators are asking for more and more and more data all the time. And so the integrity of your systems and your data become very, very important from that perspective as well. So I think that's driving some of the investment there too.
Yeah, we agree.
Yeah, I agree. And as it relates to the regulatory as well. I mean, you have with trading probably as much as anything. I mean, you've been from credit cards through all of it. Trading is probably quicker back and forth cross border that you have to deal with than any of the other stuff, right?
Yeah, but again, it's a different challenge, and right now we do not do those cross borders because of those challenges. If you think about it, but I got to figure that it's going to come in the next 5 years, 7 years. Again, back to you're going to see the people are going to want to do business regardless of borders. We do it by states today, but in the U.S. But I think you're going to see more and more where people are going to want a more seamless experience. They're going to expect it, and I think it's going to put pressure on the regulators in order to create avenues for us to run down, which means we've got to be ready when they do that in order to be able to support it.
And cloud helps that move along. Probably. I'm sorry. Go ahead.
No, I was just going to say, Matt, to that point, I think we're seeing some of that pressure on the regulators today in both spaces, right?
Yep.
There are areas where a lot of the supervision and regulation in the U.S. is entity-based, right? So you're seeing banks often have trouble adopting sort of leading-edge technologies because they have to first make sure their regulators understand the technology, understand the risks and the opportunities associated with it. So in many cases, they're fast followers at best. But the saying is, you're only as innovative as your least innovative regulator. And so what we're seeing is as the regulators sort of catch up, and they're doing a lot of really good work to do so, but they're doing it carefully, which is, I think, the right approach. But we are seeing some of that activity getting pushed towards less regulated business models. We're seeing sort of new charters emerging to help facilitate some of these activities that might be lighter touch because of the difficulties of doing that within the regulated infrastructure that exists today.
Craig, and you brought up Craig, you brought up the cloud
as
well. That's just another dimension. I heard you say the word cloud. It's just a different dimension of another place where you've got to integrate to, multiple providers, multiple, if I have 10 partners, I have 10 different locations and probably 4 different cloud providers that I got to, integrate with. It's not my cloud, or it's not my, it's everybody's. And so that's a complexity that, again, is driving us to be able to build that service capability so we don't have to create it 5, 6, 7 times, and we can plug those in. At the same time, what's going to slow us down is, and as it was said well, is making sure that it is secure and making sure that we don't break the brand. Again, the regulation is one, but think about, the fine, but the brand risk, on any of us talking on this call, if we have a big issue, is significant. It's a one stop and you're done.
Greg, as it relates to, I'm sorry.
Oh, sorry, Greg. That's actually spurring innovation in a way. So when we started this think tank, we learned 2 things. One, that reputational risk is the most important factor for financial institution. It's intangible, right? But it's directly related to the stock price if things go wrong. And having another Bernie Madoff come in, and literally we had some of the, the largest asset managers, broker dealers in Boston sitting around a table talking about their business model and concerns in the risk and compliance space. And having another Bernie Madoff come along and steal $20 billion from one institution doesn't make the other institutions, it doesn't empower them. In fact, it lowers the entire kind of systemic risk for everybody and ultimately for the consumer. So the one thing we learned is reputational risk is key. It's actually the number one thing that they care about. And I'm talking about global head of anti-money laundering and global risk and compliance and, folks, some of the largest institutions. What we also found then as a result, there was a willingness to collaborate around sharing intelligence, sharing information around some of the risk factors. So while, it's interesting because kind of by day we have arch rivals who are competing for alpha or competing for customers and new products, but by night, they're looking for a way to work together. And that kind of spurred this idea of creating a community where people could share data in a kind of a data privacy secure fashion. And that's what kind of got the regulators involved. And, we've been fortunate to work with the Fed. The Fed actually appointed me onto a focus group that they established last year with 12 industry experts ourselves, some of the large credit card processor companies and credit reporting agencies around coming up with a common definition for synthetic identity fraud, because this new type of sophisticated cyber fraud is just being missed entirely by financial institutions. And it's so exciting to work with the regulators and industry because everybody wants to do it. Everybody's on the same side here except for the hackers, basically. So I think that reputational risk is a key thing that's driving innovation in the market.
Craig, one thing I would add too is the size of the prize is amazing in this world we live. And I'm just going to give you some examples. If you go back a couple months ago, and there may have been some stocks being run up on some spots, and some of the companies shut down trading. We were not one of those who shut down trading, regardless of what it was or wasn't. Our new accounts, we booked more new accounts in 2 weeks than we did in the previous year because of that event. And that wasn't just trading accounts, that's bank accounts, net new assets, billions of dollars moved through our pipes for those weeks in order for us to have that. So the world we live in is not where, I'm not going to change a bank because it's my local thing. I'm not going to, I'm not going to change an investment. I'm not going to change a life insurance policy, whatever that thing is. In today's world, you have the ability to change those so much easier, literally sitting with your device in your hand, that the size of the prize, if you can set it up and be consistent and have that value and ensure that your brand is reliable, you can grow this thing more, from a small office in New England, you can run, you can take over national accounts.
Yeah, I mean, interesting that from the last discussion that was on, I forget the man's name, but he was talking about selling life insurance to younger kids and how they were all ready to buy it immediately until they realized that they couldn't inside of 10 minutes on their iPhone.
Yep.
Greg, I was going to ask you, as for your client base, is what percentage is regulatory agencies, and what percentage is private sector business?
They're all financial institutions, 100% private sector. So banks,
it
credit
is.
unions, and credit card processors. Yeah, we engage with the regulatory agencies from a credibility perspective, but also I think the regulatory agencies are looking to understand innovation, and
Interesting.
Their role is they're 2 steps behind financial institutions, who are maybe a step or so behind fintechs, right? Because we live or die by innovation, right? Institutions, I think, are more kind of controlled in terms of what they're doing, and the regulators themselves are really looking for ways to innovate. So we're not selling to the government, that's not our plan, but we do involve them in our community sharing mechanism, because there's a wealth of information around that we provide. We have a partner, the NCFTA, the National Cyber Forensic Training Alliance, and it's a kind of a little known quasi agency that really it's a bridge between 14 law enforcement agencies, FBI, Secret Service, Homeland Security, LAPD, NYPD, et cetera, and a group of about 100 of the largest financial institutions. And their role and their mandate is really to share financial information, similar to like an FS-ISAC. So I think the regulators are looking for us collectively, right, to the FIs and the fintechs to lead innovation. And they want to be part of they recognize that if the bad guys are using it, then the good guys should be using it too. But the long answer to 100% FIs, 0% sales to government agencies, although strong partnerships with government agencies, from a legitimacy and kind of a go-to-market perspective.
Yeah, which is interesting, and kind of brings me to a question. There's a local entrepreneur who Tim knows, who's very successful, and he's developed a few large products and sold them for multi-$100 million. And he always says, how to be successful in the tech space, or in anything really, but find the big hairy problem and fix it. And it's interesting, as you're meeting with all of these regulatory people, I'm sure that your software does a lot. And maybe I'm asking you to give out some secret sauce that you certainly don't have to do. What are some things that need to be fixed that you don't see, a plug for right now?
I think identity is critical. And and that's public information. You know, our guest speaker from FinCEN this week, you know, talked about identity. I'd encourage you to kind of watch the video. I can share the link again if you want to see that afterwards. And we have a recording of that. And she talks about identity and why that's critical. So I think KYC is not working. And if it was working, you wouldn't have synthetic identities, right? So the fraudsters are just too smart around that. Actually, backing up, the convergence of cyber and fraud, right, particularly exacerbated by COVID with remote customers, remote business, has created huge friction and challenges in financial institutions, and of course, huge opportunities for innovators like us. So I think and maybe, you know, Matt, you have some ideas around this, but in the traditional model, you had your cyber group and you had your fraud group, and they were kind of disconnected. And what we're starting to hear from large and medium-sized institutions is that there needs to be a cohesive strategy to work together. So I don't know, Matt, tell me if I'm wrong about that.
No, you're absolutely spot on. It goes back to building out an ability to see across the silos that we would have had 5 years ago, 4 years ago, 3 years ago. It's absolutely right.
Yep, and open access to the data, and then having the more sophisticated tools to address that is really key to offering new products, growth. And I mean, so we're in the fraud detection space, but one of the things that we've learned is actually so a little bit of secret sauce here, but our algorithm is able to rank when somebody applies for a loan product as to whether it's a real person or whether they were fabricated by some hacker or, you know, organized crime group on the other side of the world. And the flip side is if you turn the algorithm on its head and you say, wait a minute, we can also rank low risk items. And these clunky rules-based systems that folks have been using traditionally are creating a lot of friction in the digital onboarding space because people don't come into branches anymore, right? They apply online, and those old systems are not capable of being dynamic enough. So they're actually creating a lot of noise, a lot of friction. So much so, Craig, that from you said big, hairy problem, you know, think of the revenue opportunity here. One of our customers said the other day that up to 40% of new online applications are being put in a pending status by their existing kind of onboarding infrastructure because it looks like fraud, because the models, the rules-based models that they have in place are they're not antiquated, they're outdated from where they were 2 years ago, right? The profile of what a new customer looks like is very different 2 years ago versus today, right? Or versus 2020. So what's happening is 40% of their new account applications are being put in pending status. And as a result, 10 to 15% of those new accounts are disappearing basically before they're able to address the pending status because the consumers are impatient. And if they open an account and it takes 2 or 3 days, you know, to actually return, you know, back and say, yes, your account has been processed, they get frustrated and they move on. So think of the marketing dollars and the sales spend and all those, you know, all the investment in new products that could be the ROI you could get on that by improving that whole kind of friction process. So I don't know, digital onboarding friction. I don't know if anybody else wants to talk about that, but that's kind of the, you know, the flip side to fraud detection.
Jennifer, as it relates to some of the challenges that you've seen that you didn't see as quickly or as glaring pre-COVID, maybe give us a thought on that, if that's okay.
Well, I think we've touched upon, you know, the key ones, obviously, around security, around, you know, the pace of technological innovation having to increase so dramatically, and the fact that, you know, large institutions took risks that they wouldn't have normally because they were forced to. They had to continue to operate and to respond to consumer demand. So I think that's been a really interesting evolution. It'll be interesting to see, how does that risk tolerance change as we move through the pandemic? But the one other thing I would note, you know, in terms of what has the pandemic done, I think it's only increased the recognition that there really the need for collaboration between institutions and regulators, and not just domestically but internationally. I think you've seen a lot more collaboration from that perspective as well. These are big, hairy problems, to your earlier question, and they need a lot of minds around the table. So I think we're seeing a lot more of that happen. And I think, you know, going forward, some of the problems we're going to face post-pandemic, like climate, those are big problems, and they're going to require a lot of collaboration between institutions and governments and between countries. So I think it'll be interesting to see how that longer term that change plays out over multiple issues that the financial services industry is going to face.
It is interesting that on the one hand, you have companies trying to do more business in a different way. So you'd think that they're going to want to maybe drop some of their regulations. On the other hand, regulatory needs are increased, and certainly with some of the government movements, et cetera, you're going to see some more regulation. So it is an interesting convergence, mostly to be saved by technology. So good for us, I guess, right?
Yeah, the regulation's not going away. That's for sure. So we're all going to have to just get better at dealing with it, and technology is absolutely the solution there.
I agree. Well, does anyone have any random thoughts that we haven't touched on as it relates to what your specific situation is, as it relates to some post-COVID challenge? Not that it's going away, but we're certainly coming out of it a little bit. And as it relates to, my favorite topic, your data in and around any of it.
One thing I think will be really interesting as we sort of move into the recovery phase of COVID here, especially related to data. And one of the biggest changes I think we saw coming into COVID was change in how consumers engage, right? We've seen financial institutions invest really heavily in new technologies, but consumer adoption always lags, right? You do what works, you do what you've always done, unless there's a reason to do it otherwise. And what we've seen is a ton of consumer adoption of some of these new platforms. What will be interesting as we sort of move back to a more normal stance is how those relationships that have moved from more physical interactions to online and mobile interactions have developed, and how companies maintain relationships with those customers when there's less of a physical touch point. So, that really is all about leveraging the data, the clicks, the bits, the bytes, where by what they look at, customers are telling you more about what they want, and moving away from the sort of in-person relationship model. So I think that'll be a unique challenge over the next year or two, and looking forward to seeing how people address it.
Well, thank you. Well, I want to, Jennifer, you have one more question that came from the audience. Of any thoughts that you have as it relates to, being a Canadian, with the Canadian organization doing business down with the different governments, if that makes sense.
Yeah, I mean, I think if you think about the Canadian financial services sector, it is very outward looking. In fact, sort of we drive a huge proponent of our outward FDI in terms of Canada's outward FDI in total. We're known as a resource country, but in fact, our financial services sector is a key pillar. So, and you've seen all of our institutions, they do business in a very global manner. If you think about some of our banks where, a couple of them, half their operations are in the US now, certainly very active globally. You see our pension funds, our international investors, close to 60% of their assets outside of Canada. So I think that certainly you'll only see that increase in terms of how the Canadian financial services sector operates. It no doubt will continue that international expansion. That's how we're going to grow. At the end of the day, we're a big country with a smaller population. So the growth for our institutions is no doubt outside of our borders in many respects, and certainly for a large pension fund with a long-term horizon, they need to be diversified. So they'll continue to be international investors.
I agree. Thank you.
Craig, I just wanted to point out that I posted a link to that interview that we did with FinCEN earlier this week, in case anybody's interested. I hope that went out to all attendees. I don't know if you guys can see that, but the interview was actually hosted by a former president of one of those three large software vendors to the financial space that you were talking about, Robert. So hosted by him and a member of the policy section of FinCEN talking about their cyber strategy for post-COVID. So kind of right on point with the end of this conversation.
Very good. Well, thank you all. I think, correct me if I'm wrong, we're coming towards the end of our time.
We are, but again, if there's any final thoughts, Rob, you may have a final thought. Again, we went heavy on technology here, so I don't know if you have any final thoughts that you might want to add.
No, I think this has been a really great discussion. Really appreciate you all hosting us. And, I think we could talk about these issues all day, but look forward to the next one.
Great. And Craig, outstanding. Anything you want to add as the moderator extraordinaire here?
Well, I appreciate it. I appreciate you all having me involved. I appreciate TD for putting it all on. I appreciate my panel. I appreciate the support from my longtime associate and client and friend, Matt Minatola, and Tim and Leo for inviting me. And I look forward to more conversation. And I love this RegTech discussion. So maybe we can get into some more of that at one point too.
Good. Well, a big
Thank you all very, very much.
Thank you. Thank you. Big thank you to Craig, Jennifer, Rob, Greg, and Matt. Thank you. Thank you very much. Really appreciate your time and participating in the panel. So we are going to take a 3-minute break, a full 3 minutes, and we will be back to start our next panel. So thank you, everybody. I appreciate it. Well, I'd like to welcome everybody back. Once again, a big thank you. This is the New England Canada Business Council 2021 U.S.-Canada Business, Economic, and Trade Executive Forum. John Sorensen here, President of the New England Canada Business Council. I'm very pleased that we've had such a great event to date. Obviously, we started off with the economic outlook, got into a CEO panel, and then we just went wild on FinTech. So really pleased with the high level of speaker and content. Once again, a big thank you to our sponsors. TD Bank is a platinum conference partner, and a big thank you to TD. As we said, we have gold sponsors, Rasky Partners, Comcast, which has also been helping with the media perspective, Deckert, TMX, and you just heard from Craig Spitzer, who was the moderator for our last panel, and that's A2C. Also, a big thank you to our premium, John Hancock, and of course, associate partners Connect, which is the coalition of New England companies for trade, and the New Hampshire Business and Industry Association, and Jim Rotes. A big thank you for helping us out, getting the word out with our event. We could not do this event without our dedicated team, if you will. Leo Desjardins, Len Gold, Tom Kent, Tim Egan really did an outstanding job of pulling all this together. And again, so pleased, and a big thank you to them. From an administration perspective, the NECBC has a relationship with McKenna, and Susan Barber is our executive director, and she's done an outstanding job, and supported by Emily Clifford, who's been focusing and working with us on IT. Again, NECBC, we do focus on this trade and relationships and integration between the United States and Canada, and so pleased with how everybody has really addressed those topics to date. We are now into our panel regarding, oh, let me see, just give me a moment. The case study fireside chat. So the case study fireside chat will provide perspectives and insights from TMX and leading FinTech companies. So Dunny Lipkin will be here. He's the Director of Global Business Development with TMX Group. Marco Margiotta, CEO and Chairman of Payfare. And we're going to start off with Jeff Terry of Rasky Partners, who will be our moderator. So I'm going to turn it over to you, Jeff. Are you ready?
I'm ready.
All
Thank
right.
you, John. Appreciate
You're
it.
on.
First, I just want to thank you and your team, the Honorable Tim Egan, for inviting us to participate in this. And also, just want to start. I've just been so impressed by the quality of the presentations. Starting with Beata's keynote, I thought was great, and then all the presentations leading up to this. So hopefully, we'll be able to continue in the same vein. So fingers crossed. So you mentioned, so we've got Denis Lipkin, the Director of Global Business Development at TMX Group. Denis, do you want to introduce yourself, a little bit of your background?
Sure. So hi, everybody. Denis Lipkin. I'm part of our global business development team who works with private companies, their shareholder management throughout the world to try and articulate the value proposition of listing on TSX and TSX Venture. And then I specifically cover kind of the innovation sector and work to profile that sector to a global pool of investors and attract more capital into our markets overall.
Perfect. And Marco Maggiotto, the CEO and Chairman of Payfare.
Hi, everyone. Thanks so much for having me. Really excited to be here. So I am Marco Margiotto, CEO, Chairman and Founder, Co-founder of Payfare. Also the CEO as well, many hats. But effectively, we're a Toronto-based fintech company that is recently listed on the TSX, and we specialize in providing gig workers instant access to their earnings. And so we partner with companies like Uber, Lyft, and DoorDash, to name a few. And we've had a tremendous amount of growth recently, which we'll probably get into and talk about. So thanks for having me again.
Perfect. Great. And Denis, we're going to go to you first, but just quickly, frankly, just a little bit about myself. So I'm Jeff Terry, principal at Rasky Partners. We're the largest independent public affairs firm in New England. We're headquartered in Boston and with Washington, D.C. office. We do everything public affairs firms do, from crisis communications, media support, lobbying, government relations. We've done a good amount of work in financial services. So really excited and interested to hear what you guys have to say today. Donnie, want to
Yeah,
jump
I'll
in?
bring up my slides over here. Perfect. Thumbs up. Looking good. So just a quick brief background for those of you in the audience who might not be so familiar with TSX and sometimes even TSX Venture Exchange and kind of what our market is overall. So in terms of, if you look at the equity capital raised over the last 5 years, this is a number that surprises a lot of people of how much capital is actually raised in Canada. So 240 billion the last 5 years. Q1 alone, we actually had $20 billion of equity capital raised in our markets. And if you look at this on a global basis, we typically rank either third or fourth. So it's either ourselves or UK is the third leading market in the world for equity capital raised. You won't see names like, Japan, Germany, or other big financial centers listed there. And it really speaks to the strength of our market and being able to help public companies raise capital overall. And, given that we have a little bit of a US connection here, I wanted to highlight too, it is not just Canadian companies that list with us. It's actually a very much international exchange. We see a lot of US companies who come to our market because of the ability to tap the equity capital markets at usually an earlier stage than they could otherwise in the US. So we have about 113 US companies listed on our marketplace. And if you look at it, about $30 billion of equity capital has been raised by international companies over the last number of years. Many people will assume, oh, that's all, it's just the mining exchange, it's just the oil and gas exchange. Historically, that has been where a lot of our listings have come, but there's been a seismic shift over the last 5 years, and I'll get into another few stats highlighting that. But at this point in our marketplace, innovation and growth is really the key driver of our listing franchise and of the market cap overall. And this is just like hot off the press, as of March 31st, our innovation franchise is actually now larger than our mining franchise in terms of overall market cap. So it's $501 billion of market cap amongst our innovation companies versus 499 in our mining companies. So it's truly remarkable that nobody 5 years ago would have predicted that that could be in Canada, where innovation would be greater than mining. But here we are literally as of March 31st that it has surpassed it. And if you look at it, people know about TSX. It's a large exchange that kind of competes along the likes of New York Stock Exchange or London Stock Exchange. The average market cap for innovation companies on the TSX is about $3.1 billion. Average financing size about 122 million. But a lot of people don't know about our TSX Venture Exchange, which is where a lot of earlier stage companies go public and then graduate up to the TSX. And if you look at the average market cap for innovation companies on the TSX Venture, it's $68 million. Now, why that's so unique is that you couldn't go public in the US at a $68 million market cap. That's what the TSX Venture kind of brings forward, and it's a pragmatic exchange from a regulatory approach where it is not so overly burdensome for companies to be public on the venture at a $68 million market cap. And the goal with all these TSX Venture companies is to graduate them up to the TSX. A lot of names on terms of the logos below you may be familiar with, including theScore, which is one of the global leaders in terms of sports apps. They're getting very much into the sports betting franchise in the US. They just actually dual listed onto NASDAQ about 2 months ago. That company started off on the venture exchange, graduated up to the TSX, and is now a $1.6 billion company. And as I mentioned before, the demand and innovation has been our #1 sector for growth over the last 5 years, with close to $50 billion of equity capital raised in the last 5 years. And I just want to quickly highlight it. In Q1 alone, there's actually $10.7 billion of equity capital raised in the innovation sector. It's kind of truly remarkable to see the numbers. We raised 7.3 in tech Q1, of 2021, 2020 was a record year, and the full year was $8 billion. So we are almost eclipsing a record year just in Q1, and we are not slowing down just based upon what's been going on the last 3 weeks, including 3 very high-profile tech IPOs just in the last 2 weeks alone. And just to highlight something that's been going on, we had 11 innovation IPOs in the first quarter, including Payfare, which is a very highly successful IPO, raising $75 million. I'm going to allow Marco to really highlight the story and why they went public, and it's been a great, tremendous success since it's been public. Feels like it's been months, maybe for Marco. So it's only been a couple of weeks, maybe. I don't even know if we're at 6 weeks yet. But again, like very much showing the reception overall of both Canadian and global investors in Canadian tech names. And also just quickly highlight our TSX Venture Innovation financing, which will surprise a lot of people to see how well financings are doing on that market as well. And almost numbers that are comparable to TSX, where we see a lot of significant raises. One name I'll highlight on this list is WeCommerce, which is a Victoria-based tech company that does a lot of roll-ups of Shopify add-on businesses. Bill Ackman's actually a personal investor in this. This is all very public. That company set out and raised $60 million and almost was basically hitting unicorn status earlier this year, and it's still about a $700 million company. So again, strong continued demand from not just Canadian, but global investors into these Canadian tech names overall, and nothing that is letting up anytime soon. So I'll kind of stop there, Jeff. Hopefully that was a quick 5-minute brief.
Right, that's great. Perfect. Well done. Marco, you want to jump in?
Yeah, absolutely. Thank you for that. And I just want to confirm as well if you guys can see the screen.
Yep.
Perfect. Give me 1 sec and I'll go to full screen. There we go. So yeah, proud to be a recently listed company on the TSX, as Denny had mentioned. Couldn't be more thrilled. The whole process went incredibly smooth, surprisingly. Yeah, and so since Denny had mentioned it, I might as well hit that question off the bat, and then we can dive into a quick overview as well. But we had a number of accredited investors that made up our investor base, almost over 300 investors at that point in time prior to going public. And so for us, it was an easy transition to make that decision to go public. We had a number of opportunities, including an acquisition to acquire the whole company. We also had private equity firms lobbying in offers to acquire a controlling interest. And it just felt like it was herding cats when you have that many investors to find the appropriate valuation that everyone can agree to. Made it incredibly difficult. So when you factor that in, plus the need for additional capital to fuel the growth we have, and I'll get into that in a minute, it just made complete sense to us. And so look no further than the TSX itself. We're happy that we qualified because we typically thought that we'd have to go through the venture exchange first. But just given the growth rate, traction, history of the company, and the capital we were looking for, the TSX was certainly of interest to us, and we took full advantage of that. So a little bit about the company, really broad overview here. We effectively partner with economy platforms and offer their users a free digital bank account, while at the same time providing them either instant or daily access to their earnings. And we do this all for free. So nothing predatory here. We're here to pay everything forward. I'll explain in a minute how we make money. But really we're trying to empower these entrepreneurs to be the entrepreneurs they want to be by giving them the tools they need. And so the number one need that they have, and that we noticed early days, was that they're incurring daily expenses, but then getting paid weekly. And so for a driver that goes out there and burns through a tank of gas every day, it doesn't put them in a very favorable position to have that capital gap. And so take rideshare, for example, where many of those drivers were taxi drivers. Well, when the cash goes away, you no longer have the funds to support your activity or your work. And so that's when we saw 5 years ago, through taking many backseat trips here in Toronto, we learned pretty well and pretty quickly the pain points drivers were having. And then that's how we decided to do something about it. And so I entered the US travels and our experiences there, and it was no different. This is going to become a global problem, is the way we saw it. And so we started with a partnership with Uber here in Canada that quickly got traction, had a huge amount of success, and then rolled that out to the US, where we launched with Lyft. And more recently, we launched with DoorDash. And so really for the gig platforms, the number one problem we're solving for them is, look, no one really typically wakes up and says, I want to be a gig worker for the rest of my life. And so what we want to do is have those users, or those drivers in this case, highlighting Lyft, get out on the road as much as they can. And so by offering an instant payout solution tied to a free bank account where we can make this all happen for free, it provides incentive for someone who's sitting at home that wants to earn $100, doesn't have it right now, but by downloading our app and driving for Lyft, by end of day, or literally each and every trip, in the case of Lyft in the US, they can get paid instantly and it's all for free. And so we're really trying to help bring down the cost of acquisition for these platforms, because they spend a notorious amount to acquire these users. And what they want to do is try to monetize them as much as possible by having them work for the platform as much as possible. And that's where a free bank account, instant access to your earnings, and free loyalty rewards becomes a very compelling offering. And so I mentioned it before, it's great to offer all these things for free, but at the end of the day, we're a profit. We're not a non-for-profit. We're here to make some money. And we've found a way that we really think is a very unique, and in some regards, a few years ago, we could have said maybe proprietary, but we took existing parts of technology today and really coupled them together to really highlight this specific use case for all those things I had mentioned. And so on average, across our platform, amongst all our users and partnerships that I'd mentioned, a typical user is generating $1,000. 60% of the revenue that we make actually comes from them spending money off the card. So on average, $1,000 is going on to those cards, which is a full-on debit card. Everything you could do with your bank account and your bank card in your wallet, you could do with one of our bank accounts. And what we do is, in partnership with a bank, let's say in the US where we partner with Stride Bank, every time one of our users swipes our card, MasterCard or Visa, depending which underlying network that card is part of, and we work with both, we would earn on average, say 2.2%. And that's paid to us from the networks. Of that 2.2%, we would share 10 basis points to 20 basis points of that with our underlying bank partner. So we're the technology provider. The bank is really just providing us with the capability of issuing a MasterCard or Visa debit card. And so as part of that, they're going to share about 10 to 20 basis points of that arrangement. And then that gives us the capability of issuing a full-on bank account. And so 60% of the revenue we generate doesn't come from the gig platform, doesn't come from the gig user. It comes directly from those networks like MasterCard and Visa every time a user swipes their card. The other 40% of it comes from just user activity fees. So in Canada, we have e-transfers. In the US, just think of bill pay or transferring funds from account to account. And most of it actually comes from using ATM fee or using ATMs in in-network ATMs, meaning we do offer a massive amount, larger than any FI in the US, of free ATMs for them to use. But most people want convenience and they'll just cross the street because that's where that bank machine is. And as such, just like you and I would pay out of network ATM fees, our users would pay that as well. So it's a super sticky, recurring business model, very compelling because typically the underbanked and underserved are either chased down by predatory financial services providers, or they're just not, getting offered the standard banking products we would have. And so the reason for all that is because they typically don't earn a lot. And so that's no reason why they shouldn't be supported. And so with those partnerships we have, like with Uber, Lyft, and DoorDash, those partnerships introduce those relationships. So our cost of acquisition is incredibly low, typically about $4. And so $4 on a user that generates $22 a month is a very compelling investment. And so we've had nothing but tremendous growth over the last few years, and that continues to grow. We typically grow about 100% CAGR, and this year we're well on our way to exceeding that. So we couldn't be more thrilled. But 90% of our business activity actually comes from the US. And so although the bulk of our team is here in Canada, we're now expanding out south of the border to accommodate all the activity we have going there. Canada still remains our petri dish, as we call it, just to explore different opportunities or even new opportunities altogether. And we see the U.S. being a huge market for us, as we always did. It's going to be our #1 market for a long time coming. But we also have global ambitions, so we're launching infrastructure in Mexico, Australia, and broader Europe and UK as well. So that's kind of it. I know it's a short period of time. I hope I didn't ramble too much, but that was it as an overall summary for Payfare.
That's great. Impressive presentations, guys. Both of you guys have an awful lot of good news during an otherwise gloomy time. And I'd like to invite the participants, the audience, to submit questions if you do. I'll start. I do have one for each of you. Marco, I'll start off with you. You mentioned Canada is your petri dish. Wonder if you could talk about the benefits of being a Canadian-based company, starting your business in Canada and then expanding to the United States.
Yeah, and I'm sure Danny will touch upon this as well, but Canada is not notoriously known for technology, and I would say in the past 5 years, that's drastically changed. And so, whether it's new headquarters, global headquarters now residing, I think Netflix just announced yesterday, their Canadian office is going to be here. Amazon took a look at Toronto as a market for their head office in North America. There's a lot of technology innovation going on, especially in fintech or financial technologies. And so the benefit we really have is you don't go shoot the lights out in the US market until, you go to a similar market like Canada, where you can afford to take some bumps along the way and, learn through trials and tribulation what exactly may or may not work. And so it creates a great environment for that. I would say the only thing that it's lacking from the US is the sheer size. And so inevitably, when you look at a market that's typically 10 times bigger than ours, inevitably, if you want to scale, you'd want to get under those, in that jurisdiction to make sure you take full advantage of it. But I think the Canadian market is becoming more and more of that scenario, and the talent pool that we're tapping into globally, attracting, immigrants from many parts of the world here. And even the generational shift that's happened, with the millennials up and coming, where they may have come from an immigrant family here to Canada. They're now all university educated and focused on technology, where their parents never would have thought that was even possible. And so a lot of that is really starting to play in from, without knowing statistics behind it. It's just through my own personal experience and the hirings we've been doing. I'm seeing a lot of that.
That's great. Makes a lot of sense. And Donnie, if you want to jump in on that and also maybe expand a little bit, a question that I had for you was, I was impressed by the billions of dollars that have been raised from non-Canadian companies, right, on your exchange. If you could talk about how you attract companies, say, from the United States to choose to list with you guys.
Yeah, so, we've really focused globally on attracting listings to our market because of how unique it is with, not just the TSX, but the TSX Venture Exchange. And this two-tiered ecosystem is like no other in the world, in the sense that if you're a $50 million market cap, raising, let's say, $10 million of public capital, there's really no country in the world that would receive you well, give you banking coverage, analyst coverage, have some small cap asset managers who would be interested in investing in that name. 50 million would be like nano cap in the US, right? Like you'd be off the radar. But here we constantly see it that, not so costly to go public at that stage, right? We're not talking about it's going to cost you $5 million to raise 10 million. Like there's no point to that. We're talking about, sub $1 million cost overall, excluding maybe a bit of the cost of financing. There's not SOX to comply with, Sarbanes-Oxley. There's not, massive legal fees. We don't have punitive lawsuits going against every director and officer as a publicly listed entity. So what we see is that our bankers very much want to help support these companies, take them public at this earlier stage and grow them into these massive multi-billion-dollar companies, really support them along that journey. And we have, a lot of investors who want to be invested in these earlier stage companies in the public markets. So canopy growth, just not in the tech sector, obviously it's a cannabis company, but that started off as a $40-50 million market cap company on the TSX Venture, and has become the global leader in the cannabis space with a $15 billion market cap. We're very good at growing up those companies, supporting them, allowing them to continually access the public markets for more growth capital as they do well. We're very supportive of that, and that's what we do so uniquely. And we're continuing to see it. And interesting enough, it's just the companies that are going public on the TSX Venture are just actually bigger than they normally are. Whereas maybe they'd raise 2 to 10 million, we're seeing them now raise like 20 to 50 million almost. And I think there's just a very big appetite for, to Marco's earlier point, tech companies. Like 5 years ago, probably wouldn't have been able to be on this presentation showing any numbers because we would have been hiding it. I joke a little bit, but like now we're very proud of where we've come to. And, the fact that we raised $7.3 billion for companies in the first quarter is phenomenal overall.
And obviously incredibly impressive to be able to do it during COVID. That's and for both of you, I think the success that both of you guys have had while the borders closed, while much of the economy is closed, obviously speaks to what you're doing. Marco, I've got a question for you. Are you guys looking at the entertainment industry? When you're looking at industries that are, kind of independent contractors, is that another potential market for you guys?
Yeah, so we're really looking after any large workforce where we need two simple things to happen. One is we need access to the data to validate that user's actually earned income. And so any large platform that has, a large amount of independent contractors or, users on their platform that are looking for payment sooner than later. And then the second thing we want is if we have to fund that ourselves, and I didn't mention this during the presentation, our preference is for the platforms themselves to provide the advance of funds. Otherwise, we would have a cost of debt associated with that, and we'd have to pass those funds or that cost of funds onto that user base. Our view of the world is it should be offered for free. The gig platforms are sitting on that cash. The only reason why they're not paying it sooner, for the most part, is because there's usually costs associated with speeding up the payment. So with the network and infrastructure we've created, they can speed up or intensify the frequency as much as possible because there's no underlying cost. It's our technology. We're just going to rely on that user spending money at those merchants to drive the bulk of our revenue. But yeah, I hope that answered a bit of your question. It can go anywhere. We're looking at independent truckers as another one where we would tie into the telematics devices that truckers would have just to determine real time where they are. And sometimes on a pro rata basis, we can fund them or advance them as they're driving. 70% of them are using factoring and prone to predatory lending rates associated with that. Social media influencers is another angle we're looking at. Those users wait 30 days to get paid from the likes of Facebook, YouTube, and so on. Mass merchant platforms like Amazon, Etsy, eBay, they all wait to get their sales paid to them. So not even just an independent contractor, but even small businesses on those platforms. And lastly, this shouldn't be, something that should be overlooked in terms of, large employers that want to offer this to employees. In our world, in a few years, payday loans do not exist, nor should they, given the technology that's out there today. So integrating with payroll companies to make this happen is certainly something we're trying to push the government to kind of allow, because the first thing they look at is, well, how do I know our source deductions that belong to the government are going to be handled and settled with? And so if we can get them to buy into our model, and satisfy them, it'll change our rules that have been around for far too long to accommodate the what we want to do, which is provide all these advances of earned wages for free.
That's great. That's really helpful. And I know that all the other moderators, I think, did a great job of keeping everyone on time. And I see that Jim Brett has joined us, so that's my cue that it's time to move on. So Donnie and Marco, thank you guys so much. This was great. I thought it was really helpful and informative.
Thanks, everybody. Have a good one.
Thanks.
Thank
Thank you.
Time to move on.
Outstanding. Thank you. I appreciate it very, very much. And now we are into panel number 4.
I shall be first.
The cleanup hitters. And we're going to be well represented by Ottawa and of course here in Boston, New England, and that connection to Washington. We have an outstanding moderator from CNBC. I actually saw her on TV today, earlier around lunchtime. Deidre Bosa. She's a co-anchor for the Tech Check for CNBC. And Susan, I'm looking to see if she is on.
I don't see her yet.
Okay, do you have her number?
I do.
All right.
I'll get in touch with her.
Very good. Well, you guys get to deal with me.
What did I do wrong?
Oh, listen to you. Our outstanding panel, Washington, Ottawa Insider Roundtable. The updates on politics, policy, regulatory dynamics in the United States and Canada, our trade relationship between the two companies, and their perspectives on current and future state of our bilateral relationship and development affecting the United States, Canada, and the financial community. We are blessed and pleased to have my good friend, Jim Brett. He's president and CEO of New England Council. He'll be going first. And hold on, Jim, I've got 2 other people to introduce. Oh, I know, he was anxious. My also close friend and buddy up in Ottawa, Bill Pristansky. Good to see you, Bill, and I'm glad you were very prompt. You were prompt about an hour ago, so thank you. I appreciate it. And our new Consul General of Canada, who has just been outstanding to work with in his very short tenure. It's been great. We've had a myriad of events, and so Roger Kusner, Mr. Nova Scotia himself, and he is a Leaf fan. He has something in common with our wonderful moderator who is now here. So I'm going to let her say a quick moment, a quick thing or 2 quick comments, and then she'll turn it over to you, Jim, because I think you're going to go first. But Deidre, Dee, are you on?
I'm in good company, a Leafs fan. I thought that was going to be held against me. Thank you for that thumbs up, Roger. A few thumbs down. Can you guys see me?
We're trying, but no, not yet.
I know, I'm not sure why. I'm going to stop my video and then try again because I was in here when you were calling for me and I could see myself. But now I can't. So
I'd rather see you than Sorensen.
No,
there we go.
That's not hard.
I'll second that motion.
Yeah, I'd rather be looking at you, Deirdre, than
yeah. All right, Deirdre, I'm going to turn it over to you.
Okay.
And
thank you, John. So you
good luck,
can see
panel.
me in my home studio in the background. Is that correct?
Can.
Yep, I can see you.
Okay, great. So you know that I'm a Leafs fan, like it or not.
I can
I'm
hold
also
it.
Canadian. I live in the United States and I'm a business reporter. So I am thrilled and honored to be here. I feel it's the perfect conversation for me to host. And I was also enjoying very much the tech conversation before this because that's what I do day to day is cover business and technology and fintech as well. And a few years ago, I traveled to Northern Quebec to interview the Prime Minister on Canada-US relations. So looking forward to this. And let me not take up any more time. Let's get right into this panel because I know that we have some presentations to get to from our distinguished panelists. James Brett, I'll hand it over the virtual floor to you first.
Great. Thank you, Deirdre. And thank you to NECBC, my good friend, John Sorensen, who does a great job. And I'm sure he did a great job today in putting together this program. But I thank him for inviting me to say a few words about the New England Council and also what is going on in Washington. For the benefit of the people who are listening and watching, who may not know much about the New England Council, we are the oldest regional business organization in the United States. In fact, in just a few years, in 2025, we will be celebrating our 100th anniversary, which is extraordinary. We represent about 600 members from all 6 New England states. a wide array of industries. I know we talked about the financial service and the fintech today. They are heavily represented in the New England Council. Asset managers, investment firms, banks, insurers, credit unions, accounting, all the members of the New England Council. But what makes us unique is that we focus on federal issues and how they impact the region's economic well-being. So we work extremely close with all members of the congressional delegation. We have 21 members from New England. We work very closely with all of them. And particularly trade has been prominent in the New England Council history. We've always supported trade bills, and USMCA is no exception. We worked very hard on that bill. And basically why we support trade bills is because 95% of all our customers are outside the borders of the United States. So any chance we can find a good, fair piece of trade legislation, we embrace it. But USMCA was a bill that we really, really worked on very, very hard. Now, just talking about in Washington, the previous administration, I think the word that comes to mind for me, the relationship US and Canada, was the word tense. And I think we would all agree with the new administration, there's a change of tone. And we've seen it already in the bilateral meeting that was held on February 23rd between our President Biden and the Prime Minister Trudeau. That meeting resulted in what they call the roadmap for a roadmap for a renewed U.S.-Canada partnership. And it outlined how the two countries are going to be working together. Needless to say, on probably the most important issue for all of us, and that is the COVID-19 pandemic. But we're going to work very, very closely on that. But other issues, national security issues, climate change, and the economy. And just last week, the two nations again released, I think it was April 22nd, a new greening government initiative under which, again, the two nations will work together in their respected efforts towards their efforts of shared goal of net zero emission government. So all in all, I think it's off to a very good start there. The president selected an outstanding choice for the U.S. Trade Representative, Catherine Tai. She comes from the Ways and Means Committee that Richie Neal is the chairman of from Massachusetts. She worked on the USMCA. She knows this bill very well. She knows Canada very well. So I think that is a plus that we have someone who has a deep understanding of the economic relationship. So that is a win for all of us, I believe. Overall, the New England delegation, 21 members in the House, are very supportive of the U.S.-Canada relationship. And, you know, we have 12 United States senators, but a few of them were former governors. And they had great relationships as governors with Canada. Some actually border Canada. I mean, Angus King in Maine, former governor. Jeanne Shaheen, New Hampshire, former governor. Maggie Hassan, New Hampshire, former governor. So all of the senators really understand how important Canada is to our region. And the majority of the New England delegation, House and Senate, voted in support of the USMCA. So again, hats off to the chairman of the Ways and Means Committee, Richie Neal, who led the effort in urging his colleagues to support this bill. Also, all the governors, 6 New England governors, have strong relationships with the Eastern Canadian premier. So again, why we spend so much time in USMCA is because it was our #1 issue, the New England Council, this past year, 2020. And it had broad support from all our members of the different sectors of the economy of New England who are members of the New England Council. So even though it is probably 10 months since the signing of the bill, July 1st, we expect that Congress and the administration will be working to ensure that the provisions are implemented and will be followed. In fact, at her confirmation hearing, Catherine Tai promised the committee that she would make sure both Canada and Mexico would comply with the treaty and use all the enforcement tools necessary to make sure they do. Again, why we talk so much about USMCA is because we realize there are over 600,000 jobs supported by trade in New England with Canada and Mexico, and nearly 13 billion in exports just in 2018 alone. So very important. Now, of course, the administration in Congress, the only major item they're going to be talking about tonight, the next couple of weeks, and the next couple of months, infrastructure, the president's American Job Plan, the sweeping $2.3 trillion package that he has already announced. And tonight he's going to announce an American family plan, which is $1.8 trillion. That's going to talk about universal free school, 2-year free community college, childcare, national paid family medical leave, probably extend the tax cuts that were in the first American Rescue Plan and make it permanent. And the House will be starting all of this first, and they're going to have to do all of this with 4-seat margin. So it's going to be very, very tight to get all this through. But if you add up the American Rescue Plan that just passed with all one party, 1.9 trillion, the American Job Plan that he just announced, the major infrastructure, that's 2.3 trillion. The American Family Plan that he's going to announce tonight is 1.8 trillion. That is $6.1 trillion that this administration would like to spend this year. So it remains to be seen whether we'll be able to get the support, in particular bipartisan support, but it'll be something to watch. To do all of this, he's going to propose increasing the corporate tax. Corporate tax right now in the United States is 21%. He would like to see it go to 28%. He also would like to increase the personal income tax to a little over 39%. Be interesting to see what the support he gets from Congress on that. Republicans are now coming forward with their own infrastructure bill. Their infrastructure bill is a traditional infrastructure, road, bridges, highway, dredging of highway, of the harbors. That is probably about a $568 billion. It's a lot less than his 2.3 trillion, because his 2.3 trillion is not just the roads, bridges, and the highways. It's broadband, it's energy, it's modernizing schools and hospitals. So it remains to be seen if there's a common ground. Will they get together and come up with a compromise package? That is all something that we will watch in anticipation. There are many people who say you won't see a compromise at all. This is going to have to be passed again by all one party. But as I just mentioned, the House only has a 4-seat margin. So it's going to be very, very, very tight, to say the least. So, but this will be something that will be debated over the next several weeks and the several months, to say the least. So the other issue that we're working on is financial service. And in particular, I know you talked about the FinTech. The FinTech task force chairman happens to be from New England, happens to be from Massachusetts, happens to be from Boston. Stephen Lynch is the senior member of the House Financial Service, but he is the chair of this committee. How much is going to come out of this year? I think very little. The focus is on infrastructure, infrastructure, infrastructure. That is the biggest issue right now the administration is talking about, and Congress. So I don't see much coming out of there, but there has been a focus on data privacy and data security in the FinTech industry. But are we going to see any activity, legislation? I doubt it this year. But one issue that we're very concerned about is the Safe Banking Act, which would provide access to banking services for legal cannabis businesses here in New England. All 6 states have passed marijuana legislation, whether it's recreational or medical. But unfortunately, marijuana is still considered a federal drug. So these cannabis outlets do not have banking access to services or deposits or what have you. So we need this bill, the Safe Banking Act. It's passed the House. In fact, it just passed again this past week, but it's the Senate that has held it up. But we're hoping that this year this bill will pass. And I don't think Canada has that problem that we have right now, but it's a big issue here in New England because the cannabis industry is growing here and they need the banking access services. So, and then finally, we're seeing a major focus on diversity from all of our members. And it's been an area of particular concern for whether it's financial service or all other sectors. we have to look at ways of providing more access to people of color with small businesses, to provide more access for affordable housing. But it's an issue that is on the radar of every CEO of every business here in New England and quite frankly, all over the country, that we have to find more ways of reducing the gap, the health equity, the economic equity, the housing equity, the educational equity, and the diversity in all our boards and our employees. That is a big issue with all of our members here in New England and throughout the country. So that's sort of a update of what we've been working at, looking at, and also what we're going to be working in the next several months. So with that, I thank you, and I think Roger's probably ready to take over. Are you, Roger, or are you just?
That was, James, let me jump in. That was a great overview. Thank you. And I can tell you that diversity is an issue, certainly across corporate America, one that we spend a lot of time talking to CEOs regarding on CNBC. I believe we're going to William next. Not that I want to steal your thunder, Roger, but I'm going to ask you to wait
Just that I see Roger. I don't see Bill. I only see Roger.
I can see William. I think he's ready.
Good.
Yeah, so thank you very much, Deirdre. I echo your comments, and I'm really pleased that you were able to join us today. You know, even though you are a Canadian, but a Toronto Maple Leafs fan, I'm obviously a Senators fan here in Ottawa, and so we'll continue that dialogue at another time. But
as long as you're not a Boston fan. Oh, I think I might have just wow. People on here.
I admire both Deirdre and Bill's faith. You really have a lot of faith.
Well, I think Deirdre,
I'm sorry, go ahead.
Deirdre, you're cheering for the Rangers and the Flyers to overtake Boston so that you don't have to meet them in the semifinals. Anyway, you know, I am enjoying your new show, Tech Check, and I think that we are all privileged to have you with us today because you know, it is probably the busiest week in the quarter for results. We're kind of wedged in here between Alphabet and Apple. And so I thank you for taking the time to join the New England Canada Business Council. I know it's been 15 years since I started coming on these panels as one of the token Canadians. And I know I've always found it informative. And today I know with Roger on the panel, it'll also be entertaining. So here we go. Most New Englanders in the audience today, when asked their favorite quote from their favorite son, the 35th president would likely recite his famous "ask not what your country can do for you" quote. However, Canadians often refer to JFK's House of Commons speech 4 months later when he stated, and I have it here, let me read it: "Geography has made us neighbors, history has made us friends, economics has made us partners, and necessity has made us allies. And those whom nature hath so joined together, let no man put asunder." Until recently, JFK's words have stood the test of time. Trudeau I used the quote in welcoming Reagan to Ottawa in 1981. Brian Mulroney cited it in his 1984 speech that I attended at the Economic Club of New York. And President Clinton employed it at a luncheon in Ottawa in 1995. But the past 4 years under the Trump administration has changed everything. Canadians should never again take the Canada-US relationship for granted. And just because we have a Democrat in the White House, Canadians have what I would call a false sense of hope that we're back to the friends as neighbors era described by JFK. The Biden presidency has been heralded as great news for Trudeau. There have always been strong links between the Canadian Liberal Party and the Democrats, and our Consul General will attest to that. But the connections between the two have reached their zenith really under the most recent Democratic presidents, former President Obama, and now, given the strong overlap between the Obama and Biden administrations, this new administration has inherited those links. It's fair to say that Trudeau is quite infatuated with Obama. He regularly praised him. He highlighted any appearance with him. Obama spoke at the Liberal Party's favorite Ottawa think tank, Canada 2020, and President Obama even endorsed Trudeau in the 2019 election. There are also strong people-to-people links between the Biden and Trudeau administrations. The most obvious is Biden's presidential campaign manager and deputy chief of staff, Jen O'Malley Dillon. She spoke at the Liberal convention and tutored the party on campaign strategy. She helped the Trudeau campaign in 2015 modernize their voter outreach via digital tools and techniques, and there are many more such links throughout both administrations. Indeed, in Trudeau's wildest dreams, he carried on Obama's progressive legacy during the dark days of Trump. Trudeau is emulating Biden's Build Back Better slogan with even greater emphasis on equity, diversity, and inclusiveness. And they're aligned ideologically in terms of the threat of climate change. Jim referenced the Greening Government initiative announced on Earth Day. They're aligned on general progressivism, both socially and economically. And their domestic political coalitions are largely the same: educated, middle-class urbanites, especially women. They'll work together on border carbon taxes and global minimum corporate tax rates. But just because Biden and Trudeau are simpatico doesn't mean there won't be bumps in the road. Canada's economy, as we all know, is tied to America's, and Biden's plan to supercharge the US economy and go for full employment should be a boon to Canada. But there are strong Buy American portions of Biden's infrastructure deal, and Canada could miss out on much of the action. It'll take political leadership from the Prime Minister to ensure that Canada is exempt from many of the Buy American provisions. Energy policy could be another contentious issue. Although both Biden and Trudeau want to build their domestic green, clean energy industries, Canadian exports are still heavily dependent on commodities, especially oil. How will Canada's oil patch survive and thrive with Trudeau and Biden's new carbon reduction goals? The answer is unclear. Finally, there's Canada's plans to tax Facebook, Amazon, Apple, and other corporations providing digital services starting in 2022. When France and Canada and other countries proposed these taxes in the past, former President Trump threatened retaliatory measures. Standing up for US companies has support in both Democratic and Republican parties, and it's likely Biden will argue against Trudeau's digital tax. However, on this issue, I'll defer to Deidre's expertise. I also note that Canada now intends to tax foreign-owned vacation properties. That may affect some New Englanders in the audience today who are lucky enough to own a cottage in Atlantic Canada, or Canadians with a place on the Cape, and it could complicate cross-border travel and tourism. So to conclude my opening remarks, Canada's relationship with the US should be strong under Biden and Trudeau. As we recover from COVID, we should experience a historic economic rebound, a wave that will lift both American and Canadian boats. But even the strongest familial relationships have troubles, and we should expect some quarrels, and American protectionism remains strong in the Congress, and even Canada isn't safe from it. Longer term, there remain worries about economic competitiveness and growth, as well as an enormous debt. But after a year of hardship, Biden and Trudeau are saying, those are worries for another day. Enjoy the here and now, test negative, and stay positive.
William, that was great. I can tell we are going to have a good conversation today. Consul General, I will hand it over to you and then we will get into it. I've been taking notes, so we got lots to touch on after this. Oh, thank you so much, Deirdre, and thanks, John, for the invite to be here. And I'll come off of Bill's comments. A story that I shared with Jim and John a few weeks back in his reference to Prime Minister Trudeau's wildest dreams. Shortly after arriving here in Boston, my wife and I went to Cheers for lunch. We were down Boston Common and sitting down having a beverage, and I said to her, Lynn, ever in your wildest dreams did you think you'd see us here? And without batting an eye, she replied, well, to tell you the truth, Roger, you're not in a lot of my wildest dreams. The relationship between the two countries is strong, it's deep, it's enduring. It's built on shared geopolitical interests, on shared culture and history. It's one that's based on peace, freedom, cooperation, and respect. Sometimes we sort of get hung up on the fact that, you know, it's between the two leaders, and each president and prime minister have their own relationship. And Bill had a front row seat to President Reagan and Brian Mulroney, and they were great, proud Irishmen who got along famously and enjoyed each other's company and did a lot of good things policy-wise with the Acid Rain Agreement, free trade, maybe a little diversion on apartheid. Both of them held a similar belief, but had different approaches to the issue around apartheid. But the relationship was strong there, maybe more strong than, as Bill was quoting past presidents, one of my favorite of all times, the relationship, Diefenbaker and JFK didn't get along all that well. And then their successors, LBJ and Prime Minister Pearson, they had a rough start because Pearson didn't support Vietnam. And anyway, when he went down to visit President Johnson, Johnson grabbed him by the lapels and said, "Don't come into my living room pissing on my rug." And it's just one of the great presidential quotes I've thought of all time. But then they ended up getting together, working together, signing the Auto Pact, and you could say that was really one of the starts of the automotive industry in Canada. So, you know, it goes beyond that. Reagan said we're more than allies, we're more than friends, we're kin, and the two countries together have built one of the greatest bilateral agreements and friendships in the world. The last administration, as Bill had sort of indicated, the last was more unconventional than past administrations. It was more centrally focused out of the Oval Office, and there was a high degree of spontaneity that came out of the Oval Office. So, but nonetheless, the two countries were able to come up with the new USMCA. And as Jim had, you know, as he had commented on, it was really, the negotiations were tough. They were tense. Lighthizer was very much respected by Freeland, as was Freeland with Lighthizer, and Siad from Mexico. But they came up with a deal that received such great support, bipartisan support on both sides of the border. And you know, it's something that I think we haven't seen the benefit yet, but it's something I think that will lay out great benefit for years to come. There was an increase at the time. I know there was some pushback on the opening of the agreement, of the NAFTA agreement. But President Obama had said that he was going to open it up as well. And Prime Minister Trudeau embraced it, said the deal is 25 years old. It has to reflect the modern economy. And so let's get on with it. So it was, like I said, it was tough, it was intense, but thus far, it's, you know, I think it's one we're all looking forward to, bringing benefit to both sides of the border. Let me just, I'll comment on the new administration and where we are currently. It was 2 hours after the inauguration, our ambassador Hillman, was on a call with the officials from the White House 2 hours later to talk about Canadian issues. The first call that was made to a foreign leader by the president was to Prime Minister Trudeau. And the first bilateral was with Prime Minister Trudeau as well. And they sat down, and as Jim had mentioned as well, the roadmap that was created, it takes in a spectrum of about 30 different issues. And it's not just like a one and done meeting. the engagement is significant there, you know, from minister's office to secretary's office. The staff continue to meet on a bi-weekly basis to keep track of the progress on these specific issues. Number one, of course, is COVID, and what are the responses to COVID. But we talk about the environment, energy, the economy, security, all those issues, 30 different issues that they continue to ride herd on and continue to meet. Ambassador Hillman, who was appointed under Prime Minister Harper, she came into the office under Prime Minister Harper and was respected by the Conservatives in Canada, and certainly she holds that same respect with the current government. But she has said that she has never, in all her time, has never seen this level of engagement. So to close, it's an environment has been created that is it's positive and productive, both in conversation and in action. And so I think that can bode well for both sides of the border. Thank you. Thank you very much for that, Roger. I want to pick up, I think that James did a really good job of laying out the priorities for Washington right now. I think at one point, James, you said infrastructure, infrastructure, infrastructure. There's also taxes. There's also an economic reopening that's happening very quickly. So I guess my question, both for Bill and Roger, is how can you be confident? Yes, 30 items set out in that first phone call between the two nations after President Biden was elected. How do we get to action? It's great to say these things, have these objectives, but does Washington really have the capacity, the bandwidth to execute? Bill, let's come to you first.
Yeah, I mean, that's my worry as well. It's all great to start on 30 different things and it keeps the officials and the bureaucrats working. But, so far we haven't seen any tangible results. We were all very disappointed that, the president's first action was canceling Keystone, which was a huge Canadian priority. There's a current threat to terminate Line 5 running through Michigan. The fact that Canada is lagging behind the world on vaccinations, I think on people who've been vaccinated twice, fully vaccinated, we're at, 2.5%, which puts us at 72nd in the world. And yet we've approved AstraZeneca. The US is sitting on a stockpile of 60 million doses of AstraZeneca vaccine. And, we have, I think President Biden has loaned us 1.5 million doses up till now. So, Trudeau talks about the special relationship. And I think, I think that he hasn't got any proof that it had any positive results yet for the country. And I think if you spread yourself too thin, what we've learned in government, a lot of talking gets done, but not a lot of action. I'll give you one more example. On China, he talks about, getting a resilient, reshoring and getting a resilient supply chain back into America. He should be saying North America. Canada's got to, and I know our Consul General will be part of this, but there'll be a lobby campaign right across the country, with governors and senators and representatives to make sure that the message back to the administration is that we've got to think more along the lines of a North American supply chain and reshoring to North America, not just to America. So those are a couple of things that I think are big priorities that we haven't been able to address yet, and that we've got to figure out a way to do that. Otherwise, we're going to get lost in a lot of talk and no action.
Roger, I'll let you respond to that. What gives you reason for optimism? Well, yeah, in Bill's comments, he's sort of half right and half wrong. So I'll take the half right part first. The supply chain is absolutely integrated, and we have to be aware of that. And of course, we get a little spooked when we hear Buy America, but there's always been a Buy America provision since the mid-30s. And so at least with engagement now with the US officials, we hope that there won't be any unintended consequences. And the one that typifies it best is the auto sector. A park that could be built in the United States, they call it an industrial tourist.
And it may go to Mexico to get modified or added to. It may go to Canada to get added to or put in something. And again, they buy a bad T-shirt every time they cross. By the time that automobile lands on the dealer's showroom floor, it's got 8 bad T-shirts. That's the level of integration that the sector, the auto sector has, but many sectors have. And the business community that we're talking to today, I think they understand that as well as most. So I agree with that. With regard to the vaccinations, it's not that Canada is doing so bad. It's that currently in the United States, the states are knocking it out of the park. They're doing really, really well. With the G7 nations, we are third in getting vaccinations out, not the second dose, but shot in each arm. We are third after the US and the UK. We have no domestic production in Canada because in the mid 80s, there was a privatization. Bill might want to speak to this as well, but we had a lab in Canada that was run by the government, and during privatization, it was sold off, half it was sold off, and then it had been sold off. So there's a whole story around that. But the fact is that we are getting vaccinations out. The Prime Minister said we were going to get them in the arms of Canadians by September. Canadians are pretty cool with that. That's pretty good, and that has moved up considerably as well. So it's not perfect. We haven't had the numbers initially. The initial response to the pandemic. Canada did okay. We've got some hot spots now with the variants, but we continue to work hard. And this month here, the doses that are coming into Canada now are coming in by the millions each week now. So I think the ramp up is going to prove beneficial in the short time too.
It has been slow, but even I'm in Canada at the moment and do see a ramp up over the last few weeks. I'm sure, Bill, you want to respond to this, but let me get to James because we do have an audience question, and I encourage everyone who's watching to please send in your questions or comments. This one for you, James. Since Canada promotes environmentally friendly transportation and a Biden administration plans to fund rail expansion, what are the roadblocks to get past in trying to build a high-speed rail between Montreal and Boston?
Well, President Biden is a big supporter of rail. He is somebody that used Amtrak every night going from Washington to Wilmington. So he is a strong supporter of rail trains. There'll be an awful lot of money in here for rail. We have the Downeaster that has proven to be very successful from Maine all the way down to here to Boston. We've always talked about the Boston to Montreal. It would require an awful lot of the advocacy of the members of the New England delegation to support that. But it is something that I have heard members talk about over the years. As I've stated, there's $2.3 trillion in this infrastructure. So if it's the will of the members to do this, now is the time. And I know there are other projects that are being discussed here in New England, but this would be a very interesting one to bring to the members of the delegation.
When we talk about that $2.3 trillion infrastructure package, in my role as a technology reporter, we focus less on the traditional parts like roads and bridges and highways, and much more on the chip shortage that we're seeing that is hindering automobile companies, about broadband access. And, Bill, as you were talking about Keystone and, what could come for Canada's oil industry, it occurred to me that this morning I was talking about Shopify, which is now the biggest Canadian company, a tech company nonetheless, which is just growing like crazy, has made an impact on the world stage. So I wonder, Bill, do you think that this current relationship is better for the technology sector, perhaps? Can that pick up perhaps some of the disappointment so far in terms of oil and potentially infrastructure between the two countries?
Yeah, well, certainly technology is important to Canada, and you know that Toronto Waterloo corridor has got incredible potential, and in fact, not only have you seen a startup like the one you've mentioned, there's many more in the pipeline, and also, you know, the University of Waterloo is sort of the first choice for the Googles of the world and the Microsofts of the world to come and get graduates. And they've even figured it out that rather than bringing them to California, you can pay them a lot of money to stay in the Waterloo area. And so they've set up campuses there and in Toronto and other places. So certainly because of our university system and the Consul General knows the great university system that's in Atlantic Canada that has everything from small, great universities to large universities like Dalhousie. They've got the whole gamut, and I guess we have to mention Cape Breton has a university just because he's here, and he would admonish me for not saying so. But we have, I mean, that is certainly the future. There's no question. But you know, the problem we have in Canada is unless we find some solutions to the oil and gas sector, I mean, you've got an entire part of the engine of the economy in Alberta and Saskatchewan that if they feel that the federal government isn't doing their part to influence decisions in America that influence the flow of oil and gas down to the Gulf or other places, that you know that we have a Western alienation problem that's real, and the Prime Minister and the government has to keep an eye on that. But certainly I do agree with you that the gig economy that you talk about and the kinds of startups that we have in Waterloo region because of the University of Waterloo, it is an enormous potential for the future of the country, no question about it.
Yeah, and you know, at the same time though, Bill, I remember, I think it was early 2018 when tensions kind of at an all-time high over the tariffs that the Trump administration imposed on Canada. I went to an aluminum smelter in northern Quebec and spoke to a bunch of workers there who, you know, didn't think that the Prime Minister was being tough enough, and they worried about their livelihoods, still a really important sector for Canada. So Roger, I wonder, there's still some uncertainty when it comes to that Buy America policy. We didn't get any guarantees on that first bilateral phone call. And I wonder if you think that's important. Does it risk allowing sort of some leftover tensions from the previous administration? Does it allow those to potentially simmer?
Well, again, as I said, there's been a Buy American provision from the mid 30s, and it's common sense that $600 billion a year the federal government here in the United States spends on procurement. So they would want the benefit to go to American workers and American corporate America. And with this new infusion of money through the infrastructure, obviously they would want to be the main benefactors. But again, I think we don't want to, the Buy America stuff, it's such a powerful political statement. Everybody can rally behind that. Democrats and Republicans can both, but it's so integrated. You may do something that, impose a tariff that has an impact on a fairly broad range of consumers. In the last administration, there was a tariff imposed on softwood lumber. And the average, I think they put the average house at about $250,000 in the United States. I know they weren't buying houses in Wellesley, but I think they used that figure, and it would drive the cost of the house up. The tariffs that were imposed drove the cost of that house up by $8,000 to $10,000 at the time. I would hope, in the perfect world, that you don't get into that sort of tit for tat trade. When you had mentioned vehicles and how there are a lot of lots that don't have vehicles now because they're waiting for computer chips, from the critical metals. And when you look at the critical elements, copper and nickel and cobalt and the platinum group, I mean, they come from mines in Canada, and so the trade is so interrelated. It's like in the auto sector, it should be Team North America versus Team Asia versus Team Euro. And that's where we really get the most bang for our buck. And that's where we bring the most benefit to both sides of the border.
Yeah, I think you're right, Roger, that in the auto sector, that's the case. I'm just worried about a whole bunch of other sectors that are really in danger. If you've got the kinds of numbers that James put on the table and that they're talking about for infrastructure, and Canadian companies are not allowed to bid on those projects, which right now they wouldn't be, that's a huge loss for Canada. So, you know, it's all great for Trudeau to say he's got a great relationship, but we have to put on an enormous lobby campaign to make sure we're not left out. And it involves everybody. It involves all the consul generals like yourself talking to your local senators and representatives and governors to get them on side, especially the ones that are in border states, to lobby the administration to make sure that we are exempt from those kinds of provisions. You are right. It's great. It's great political theater to say, buy America, buy America.
Yeah, if you can get something on a bumper sticker, it's great politics, but probably not great policy. Right. But know this, that when the past administration came with those tariffs and the levies, the response by the Canadian government was perfect. You know, and anybody will tell you that it was surgical. They went to the areas and put counter duties on those products that would most be impacted by the people that would influence the White House. And so you saw the duties dropped after a period of time. So
like
that was
Kentucky bourbon.
Exactly. But they worked around the White House. They didn't have a great deal of success with the White House, but the governors were receptive, the senators were receptive, Congress people were receptive, and it was liberals and conservatives together, standing shoulder to shoulder, because they knew that the importance of trade was bigger than anything politically, domestically, politically. They knew it was more important, so they stood together, and I think they had success over time.
I would just say that I think you have to be fair to the administration in the sense that it was February 23rd that they issued the roadmap on the partnership. I think if we're going to be critical to say, well, they didn't talk about Canada in the sense of putting some exemptions in there, I think that's part of the negotiations. They're just pushing this out now just to say, look, these are some of these are some of the lofty goals that we have between these two neighbors. But in the meantime, this is where the trade negotiator gets in. This is where the members of Congress play a role of saying, hey, wait a minute, there should be opportunities for Canada to be exempt on certain products. I believe in the Great Recession, 2008, 9, they talked about Buy American and all that, but they also said, let's make some as it went along, they made some exemptions there for Canada to participate. So I'm optimistic because I think they have some excellent people in the trade office and in the administration that will work this out as the months go on. But right now, their primary focus is nothing but the COVID-19 pandemic and getting the economy up and running. And they will take care of these issues, I believe, down the road, because that's the role of so many people to negotiate all of the fine points.
I guess all I'm saying is I'd love to see some goodwill. You know, we need vaccines desperately. The people in Peel and Toronto region and out in Alberta and BC, it's a desperate situation. And because for political reasons, we've decided in Canada that 4 months is okay to wait for your second shot, even though the CDC says after 40 days, there's no science to support that works. So we're in a real bad situation in Canada with vaccines. And all I'm saying, let's have some goodwill. Let's have the Prime Minister pick up the phone and get 10 million doses sent up to Canada. That's all I'm saying.
And that, the science is there to support the extension on the AstraZeneca.
Actually, that is true. I got AstraZeneca for that very reason, that the science supports that the longer you wait for the booster, you have higher efficacy. But for Pfizer and Moderna, that's 40 days is kind of the maximum, but Canadians are going to wait 4 months. My 90-year-old father was told he had to wait 4 months. It's crazy. And America could help us. That's all I'm saying.
Yeah, Bill, I've got family in Toronto also who are anxious for more shots. And it's hard to see because, you know, I'm based in San Francisco and nearly everyone I know there has had their vaccinations. So I also understand where Roger's coming from. I do want to touch on fintech, given the theme of today. And James, you mentioned something in your opening comments, which was interesting. You said you weren't optimistic that you said you doubted that there would actually be action this year, even though things like data privacy are really important. And, you know, we've just seen this incredible transformation over the last year, the financial system, you know, branch closures, the rise of fintech companies, digital payments. So I wonder how it's affected the US-Canada financial community. And just before I hopped on with you guys, I was watching Fed Reserve Chair Jay Powell talk about central bank digital currencies. So, you know, it is top of mind. You had Jamie Dimon, the CEO of JP Morgan Chase, also talking about more regulation for the sector as well. So, James, I wonder, why do you think that it's unlikely that we will see action, especially what we've seen this massive acceleration over the last year in fintech, in people using it too, and perhaps some of the risks there as well?
Well, like I said, Stephen Lynch, the congressman from Boston, is the chair of the FinTech's task force here in Congress. And he's indicated to members of the New England Council that because of the other issues that are dominating the committee, Maxine Waters is the chair of the Financial Service Committee. She is very, very aggressive in trying to find affordable housing for people of color. She's very interested in diversity and making sure the financial industry opens up that area to people of color. These are her priorities. That the fintech is Stephen Lynch's. He's the subcommittee chair. He is concerned about the data privacy and the data security, but I don't know. He'll have hearings. He will have hearings. He may bring in some of the people you just mentioned, but does it lead to legislation this year? I'm not optimistic at all.
Okay, on the Canadian side, Bill, I wonder too, what you think the need is when we've had this proliferation of digital services, right? And you have more companies coming in that are not traditional banks offering loans and different financial services. What's the appetite in Canada for that kind of regulation, especially as we see the rise of cryptocurrency as well?
Yeah, I mean, Roger knows better than me that, you know, the OSFI and all kinds of regulatory bodies are looking into this. I think the balance of that, though, is that the consumer is asking for it and liking it. And I guess the pandemic in one way has expedited consumers using these services, obviously small businesses using companies like Square and PayPal. And so you are right, cryptocurrency is something that, you know, I don't understand, and I've tried to understand it. I know your job is to understand it. Maybe you can do a seminar on it, but these are all challenges for regulators and legislators. And I know when Roger was in the House of Commons, that it's one of the things that concerned him was, you know, on one hand, you know, Roger was the greatest proponent of anything good for the consumer, but, you know, what kind of protections are there? And you know, the Canadian banking system is so different than yours, and that, you know, we're dominated by 6 major players. We don't have the regional bank system you have. We have co-ops, but so our system is quite different from that perspective. And they used to have big political power because they used to be able to give big political donations, and their political power has waned a little bit, but they're still, you know, they're still integral to our economic prosperity, and many of them, as you know, have expanded it very successfully into the United States. I mean, they always say that on every street corner in New York City and Manhattan, there's a Starbucks. Well, there's also across the street, there's a TD Bank. And probably most Americans, the bank there, don't even know that it stands for Toronto Dominion. But it is a primary issue for both regulators and legislators. And I think it's too soon for me to really tell where it's going to go. Because on the other hand, you know, for instance, in America, I know there's a bill been proposed that, you know, businesses have to take cash. We don't have that kind of bill in Canada, but I'd like to see it because there's a whole, your previous panel had someone talking about the underserved and the working poor. and many of them don't have bank accounts, and many of them deal in cash only. And so therefore, you know, we've got to protect those people somehow as well. So there's lots of issues, even though these are great things for the consumers. In fact, I'll end on this. We were in Stockholm a year and a half ago, and as you know, they are really advanced on digitization. They actually were going to get rid of their actual paper money, and I think they've brought that back. But there was a homeless person on the street looking for money, and we said, well, let's give him, you know, a kroner, and he said, no, I don't accept cash. He had a square.
Yeah, you know, in China, you'll see peddlers sort of outside with a QR code so that you can transfer directly into their WePay or Alipay account. Bill, it's a great point when it comes to the underbanked. That is the mission of a lot of these fintech companies. It's a tricky balance, though. And also, if you're a little confused by cryptocurrency, that's totally fine, because I'm still trying to figure out Dogecoin's rise and, you know, some of the NFTs that are coming out. Roger, we have a few minutes left. Let me give the last words to you.
Yeah, I want to let you know I still have a checkbook. That's how out of date I am. So, but things, and Peter Tingley had summed it up pretty good. The fact that people are well ahead of legislators on a lot of stuff. You look at the energy sector, the movement of capital, the movement of investment has been toward the sustainables and the renewables. 80%, solar has come down 80% in the last 10 years. In the last 10 years, the cost, lithium batteries would cost about $1,200 per kilowatt hour. It's down, they're targeting $60 per kilowatt hour now. And that's where the money seems to be going. And you're seeing the same, you know, it's tough for legislators to track and regulate, get ahead of the fintech sector, because it does move so fast and so vast. Cybersecurity is something I think that, you know, not that you want government to solve the problem, but if you develop some partnerships on, you know, co-creates or something like that, I think that we can go a long way. Cybersecurity has been a huge component in so many aspects of our life now, from, you know, elections to, you know, we'll pick anything, border security, national security. So it's tough for legislators to stay ahead because things move so fast with the technology.
Absolutely. And that's another topic we're constantly talking about on CNBC as well. I think that we are up in terms of time. I could keep this conversation easily going for another hour. So, I've got 2 minutes. Okay. What about a fun question to end on then? Let me just think here. We've only got 2 minutes left. Let's go around. What is the thing you're most looking forward to when the economy opens up, whether that be a Leaf game in person or a vacation? Roger?
Fenway Park, watching the Jays come down and play the Red Sox, and some street meat from Lansdowne Avenue.
A nice one. James?
I'm right across the street from the garden here, and I look forward to seeing the Bruins again, raising the flag, you know, champions once again.
Sore topic. My husband's outside here somewhere, and he's a Canucks fan, so we're going to.
Another man.
Sounds okay though. Bill, last one to you.
Well, I want to see the Sens raise the flag for sure, but I want to get down to Toronto to watch Vladimir hit those home runs. I mean, last night, he hit 3 home runs in one game, and his father never did that. So this team has such great potential, and I was an original Jays subscriber years ago, and had to let my tickets go when I moved to Ottawa. But the Jays are for real, and I'd love to see them playing back in Toronto.
I'll leave you with a little fun fact. My youngest brother's name is Mookie, after Mookie Wilson, because fourth child, when he came around, they didn't have a name, and my dad was at a Jays playoff game, World Series game, and Mookie Wilson got a home run. So we are simpatico here, guys. It has been a real pleasure. Thank you to John and the rest of the team for asking me to do this, and all the best. I hope to talk to all of you again in the not too distant future. John, back over to you.
Thank you, Deidre. Wonderful, wonderful job. Outstanding. Really appreciate it. All the way from San Francisco. So that's good. Again, Jim, Roger, Bill, wonderful job. Thank you so much. Really, really, really appreciate it. This has been a great day, a great event for the New England Canada Business Council. I want to thank once again our sponsors, TD that really stepped up from the platinum level, as we talked about, Comcast, which is CNBC. Thank you very much for getting involved. Rasky Partners, Deckert, TMX. We heard a lot about them today. A2C, John Hancock, and then our associate partners Connect, and then New Hampshire Business BIA. Again, we had a great staff putting this together. So my partners in crime here, Leo, Len, Tom Kent, Tim Egan, thank you again, and Susan and Emily, great job on the IT and the administration. So we had a wonderful event. We are going to start a little networking reception. Everybody has been sent the link. That'll start up in 4 minutes. So for those East Coast people and Atlantic people, I don't know if you want to have a cocktail yet, Deidre, in San Francisco, but we're going to have a cocktail reception from 5:45 Eastern time to 6:30 p.m. And the link was sent to everybody. And so you have to go off this link and then on the new link for those that want to participate. Or you can have a cup of tea or whatever anybody would like, but we'll be there from 5:45 to 6:30. Once again, thank you to everybody. It was a great event, and we will see you hopefully in our reception. Bye now.